that maybe we've seen in the equity market. So at the moment, we are seeing bonds kind of fairly flattish here in Europe, but equities look like they're going to suffer. Look, fair value on my screen looks like a kind of 1.5% move to the downside here, Critty, in terms of what we're going to see for European equities. Keep an eye on Ericsson, keep an eye on international paper, keep an eye on LVMH into the numbers a little bit later on as well. That's going to be an interesting trade as well. So here we go. European equity markets are open. We're expecting certainly the FTSE 100 to sink at the start, so we'll see what happens there. That is certainly the early trade that we're going to be anticipating in terms of, well, let me give you some points in terms of the big movers and where we're seeing the downside. Novo Nordisk is down by circa 2% this morning. That's the biggest points drop. Some of the oil stocks are down as well, so Total is down. LVMH is soft into its numbers a little bit later on. But what you're looking at here is some big heavyweight names that are certainly suffering. I think Airbus, just keep an eye on Airbus. Airbus, I think, is ex-dividend today. So just kind of factor that into your thinking as well, where maybe you see that story moving. But if you think about kind of some of the stocks that we watch out for, Novo Nordisk is down, Astra's down, LVMH is down, Schneider is down, some of the banks are down. Now, the banks have been big gainers. That's the sector story in front of you there. That's not all of them, but you're kind of getting the picture there. This is a fairly negative picture that we are looking at here first thing this morning. Now, as I say, what do you do? Is it fear? Is it greed? What do you do first thing this morning? Do you buy this dip, or do you believe that maybe this sell-off has potentially still some way to go? That is a story that I think markets of investors and traders have got to figure out first thing this morning on how they're going to do. But certainly the early indications are that tech is under pressure. ASML is down. You've got Novo Nordisk also softening up. LVMH is down fairly significantly as well. That's where the kind of the point story is. In terms of where we're seeing some of the upside, top Denmark is up. You've got Nokia, interestingly, trading higher. Let me just get you a price on Ericsson. Let me just see what's happening with Ericsson first thing this morning. No, that's the ADR. Give me a moment, and I'll get you the right price if I can spell it on my Bloomberg. So we'll see what's happening there. So the early indications are that that stock was likely to open higher. Let's see if we've got an early price on Ericsson. Yet to see that one come through. So we'll watch and see what Ericsson does in a few minutes' time. But the kind of the setup to this trade is that basically what we saw yesterday was a retail sales number that was strong. We saw, therefore, yield spiking higher. You also had, remember, when it comes to the equity markets, maybe the end of tax selling, that's going to be a factor as well. The central banks are now in an interesting position, certainly over in the United States. This feels increasingly like a no landing. So what do you do? Are we going to be pushing out rate cuts until next year? Well, let's hear what Williams and Daly had to say on that subject.
Real interest rates now are considerably higher than they were before because inflation has come down quite a bit. So we will need to start a process at some point to bring interest rates back to more normal levels. And my own view is that that process will likely start this year. But again, it's going to be driven by the data and achieving our goals.
The worst thing we can do right now is act urgently when urgency isn't necessary. The policy's in a good place. We're in the ready position. We can respond as the economy evolves. The labor market's not giving us any indication it's faltering, and inflation is still above our target, and we need to be confident it is on path to come down to our target before we would feel the need, and I would feel the need, to react.
Inflation's not coming down significantly. The labour market looks pretty solid. San Francisco Fed President Mary Daly there. John Williams taking maybe a more kind of consensual approach at the center of the FOMC, certainly a voice that you want to be listening to at the New York Fed. So where does that leave us and where does it take us? Let's try and get an answer to that question. Christian Muller-Glissman, Head of Asset Allocation Research at Goldman Sachs, joins us now. Good morning. Feels like we're heading towards 5% on a US 10-year. How does that change the picture for you?
Yeah, certainly feels like it. I think the important thing to note is I think 5% is not so crazy considering where the macro picture is right now.
Yep.
I think as long as growth is good, equities can deal with that, and the economy possibly can deal with that for some time. I think the challenge is always with regards to bond yields, level, speed, and source of the increases. I think level-wise, that's a long debate. I think we might argue that, closer to 5% is the new equilibrium we have without a recession around the corner, with a no-landing scenario.
Yep.
What the market doesn't like is the speed. I think it's been too fast a move, and it's come at a time where arguably the source has not been linked to growth as much. It's been more linked to policy, where the market is reassessing the kind of new neutral rate, and that is something that equities don't really like right now. And you have to consider that also in the last few days, you've had a few kind of things going on, like Middle East tensions, you're entering earnings season, earnings information so far has been a bit mixed. You could say, with some of the Magnificent Seven at least being in focus.
Yep.
So it feels like a bit shaky.
A bit shaky. Can we get through the shakiness? Can we push on to further highs? Is this something that is going to become more problematic for equities? Oh, we've had a very good run. This has been a sensational run for stocks. Yeah. Is it harder to make gains from here, given the headwinds that you've just discussed?
I think you make a very good point here. I think we've had a phenomenal start to the year. We had a phenomenal rally. If you look at positioning and sentiment indicators, they were elevated. And understandably, though, like there was huge momentum, kind of investors were possibly squeezed a bit into the market. So you have a bit of a setback. But stepping back to the fundamentals and the macro, in a broader scheme of things, growth is good and inflation is coming down and central banks will cut rates. So overall, equities in this type of backdrop should make progress. So we have to be clear on the growth side, which currently is a bad thing, like the retail sales you were mentioning. We are still having a lot of positive news flow that can be supportive for equities. But also important is outside of the US, actually inflation pretty much everywhere is coming down. And I think you mentioned the labor market this morning out of the UK. I think generally the macro picture outside of the US has been weaker. And generally that eventually should mean there's a bit for the bond market emerging. You should stabilize the yield levels. So growth is good, yields eventually find the equilibrium, and you will get some cuts, probably not as many as people were hoping. All of that should be making equities stabilize and equities can make progress. Are you going to get as strong returns as you had at the beginning of the year? Probably not. There will be some moderation.
Christian Secreti, talk to us about where the bond market fits into all of this. If there's an expectation of higher yields in the near future, what incentive is there to hop into bonds right now?
I think as a near-term investor, you have to consider how much yields can go up, and that costs you relative to really what the bond market can do for an asset allocation kind of portfolio. And the fact is, if you look at a 300-year history of the US 10-year yield, is a decent history. You could argue from the beginnings of the US, really, the average is actually 4.6, which is more or less where we are. If you take out the 70s, the average yield is 4.4. So you have to ask yourself how much further, especially in the medium term, 10-year yields will go to kind of be a drag on fixed income allocations relative to the benefits you're getting. The benefits are a real yield, which is reasonably attractive. The closer you get to 2.5, I think that's the level we've been saying that it's a bit of a speed limit for the bond market to sell off further. So 2.5% real yield, that's actually slightly above average, and it's a pretty decent yield in the world we live in. And on top of that, you have to consider that there will be protection value when you need it. I think we have several indications this year that, for example, when you have Middle East tensions, geopolitical shocks, but also selective growth shocks, that the bond market will buffer in these scenarios. Doesn't feel like you need that right now with the data, but that might change in a few months. So I think the longer your investment horizon gets, the more you want to think about the bond sell-off right now as an opportunity to maybe get to the type of bond allocations you want to be in the medium term.
Well, that's my question there, Christian. You're talking about it serving as a sort of buffer in your portfolio, even in the face of just geopolitical risk. But we're seeing the exact opposite. In fact, you're seeing incredibly weak auctions in the same week that you had attacks on between Israel and Iran. You had, of course, concerns between Russia and Ukraine, not to mention the various other geopolitical conflicts around the world. Geopolitical risk is increasing, and yet bond demand isn't. How do you square the two?
I think it's a great question. I think there's a few things at play here. I mean, first of all, the geopolitical tensions as of now have been remarkably contained. And even in the kind of commodities markets, the spillovers have been relatively limited. So I think the challenge is we've been through a few geopolitical tensions. The market has maybe become a bit desensitized, especially because the immediate kind of second round effect, the immediate shock isn't as clear. But I would still say that if you have a serious escalation, the bond market would react. And with regards to the auctions you were mentioning, I think that's a concern we've had since the summer of last year, that there is a lot of issuance coming and investors need to be incentivized to buy these bonds. The incentive can come via a flight for safety bid, or it can come via the yield. We know there's like roughly 8 to 9 trillion in money market funds right now. And I think that's part of the process of luring these kind of 8 to 9 trillion to extend duration to buy longer dated bonds, that you push up yields a bit.
Let's talk a bit, you mentioned just a moment ago, maybe owning bonds for some insurance. That at some point there is going to be a problem, at some point that we're going to need those bonds. Does the no landing scenario ultimately lead to a hard landing scenario? Because that's going to be the worst case scenario, certainly for risk assets right now. And if I'm thinking that's kind of the trajectory we're ultimately on here, that higher for longer ultimately means the economy gets hit harder, when do I start to think about that? How quickly can that kind of evolve throughout 24 and into 25?
Yeah, I mean, you want to think about tactical and strategic allocation. Yeah. When I said earlier with the medium-term outlook, you want to think about adding duration. That's the strategic asset allocation discussion. Yep. The tactical allocation discussion is a tough one. We know that. Timing recessions, timing big bear markets is very difficult. We are late cycle. And you can see that in a variety of metrics. The unemployment rate is very low. The output gap is positive. You have profit margins being elevated. The equity risk premium is low. Credit spreads are tight. These are all telling you...
That's quite a list.
These are all telling you a late cycle, but it doesn't mean that you should worry on a tactical horizon. You can be in such a backdrop for a very long time. The thing I'm watching in particular is the private sector financial balance. That's the overall health of the economy. Households and the private sector.
What's that telling you?
Right now, it's very early cycle. Like you actually have very little leverage in the household sector, very little leverage in the private sector. That means that this late cycle backdrop could last a long time. So what I'm saying is, in a tactical horizon, we're not worried about needing bonds, if that makes sense, at least with regards to the US economy. But there can be global geopolitical shocks. We have to admit as well that Europe has been a bit on a weaker footing. Improving, we have to be clear, we're going through a global manufacturing recovery. We also see that in the China data. I think it does feel like there's a variety of improvements on the growth side outside of the US as well. But I would say that unanticipated shocks, they're always something that can help the bond market perform. And generally, I think the longer your investment horizon gets, I agree with you, the longer you're on a late cycle backdrop, the more you worry about imbalances occurring, re-leveraging, and eventually that creates vulnerability.
That's why you buy insurance. Christian, nice to see you. Very nice to see you. Christian Muller-Glissman, Head of Asset Allocation Research at Goldman Sachs. Thank you very much indeed. Ugly start to European equity trading this morning. Let's look at the kind of the core stocks that we watch every day, just to kind of get a read on what is happening here. Look, you can see it. Look, it's really interesting going left to right on that screen in terms of what is happening. Nova down, LVMH into its numbers later down, Ferrari soft, ASML nearly 2% to the downside. Schneider's even lower than that. That's the kind of the AI trade that has been priced in there. Then you look at Nestle on the right-hand side of the screen. Verve offers kind of some defensiveness this morning, some opportunity maybe to seek some safety. So Nestle only down by 0.3%. What else are we watching? There's some interesting moves elsewhere that we need to be paying attention to. Joe, over to you.
We're going to start with one of the very few stocks that are green today, because 90% of the stock 600 is in the red this morning. But one stock that is leading the gains is Ericsson, jumping around 6% over in Stockholm as their earnings beat expectations. They are finally predicting a bit of a recovery in margins, given that some of their customers coming back and putting in orders. We saw a read-through in Nokia rising at the open, but giving up those gains already, given the downturn in broader markets, and not seeing that sustained feed-through. But Ericsson, a clear outperformer today, up 6% at the moment. We'll flip over and have a look at a couple of UK stocks. We did get that higher than expected wages number out of the UK, but then the unemployment number also higher, taking the sting out of it. But red on the screen in terms of the banks and also the home builders as well, and a couple of single stock decliners to bring you. Take a look at Doc Martens, down another 25%, yet another profit warning from the maker of boots here in the UK. More bad news for them. And TransferWise, we had in stocks to watch, another slowdown in their payments, falling further below that IPO price that we showed it had recovered to earlier. Both of those stocks slammed today. We'll then take a look at a couple of others. We're going to bring up UBS very quickly, because this one, there was a report out on the Swiss finance minister talking about the financing needs at UBS. Potentially they need more capital, tens of billions is what's being speculated by analysts, and the finance minister kind of reiterating those concerns. Down 2.8%, potentially though more to do with the broader market move today. Quick look at paper. We finally got confirmation of this takeover deal. DS Smith and International Paper doing that merger that has been speculated for a long time. DS Smith actually declining though, potentially people wanted a higher price for that. Mondi was the rival bidder, and that one getting a little bit of relief today, up 0.4% at the moment. We'll take a look at a couple of others. We got a few morning calls to bring you as well. We did do IAG over in the pre-market stocks to watch. There it is on the screen. So Citi predicting a recovery. They do have a buy rating on that stock. It is a positive catalyst for them, but can't catch a break. The broader market dropping. IAG down 1.5%. Finally, one more to bring you is Swatch, the watch retailer. This one is negative. It's over at Morgan Stanley, downgrading their price target to a street low. It's 190 Swiss francs. It's trading at 196, down 2.4%. They say Swatch is too exposed to the low end. You're better off buying Cartier watches, Richemont, that kind of thing. Avoid Swatch, according to Morgan Stanley, and that stock down 2.2% this morning.
Buy a Cartier. Joe, thank you very much indeed. Joe Easton joining us from our equities team. Equity markets look a little like this. Little catch-up trade this morning. Certainly no dip buying happening. Equities are down fairly solidly here in Europe, as you can see on the screen. Up next, we're going to talk about Wall Street banks. We'll do that in just a moment. Another big day coming up. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze today's markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
DOJ or other authorities
Could face bigger challenges next.
Was going to keep reading World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
We feel very good about our first quarter results, which reflect the strength of our world-class and interconnected franchises and the earnings power of our firm. This performance was aided by the swift actions we took last year to narrow our strategic focus and play to our core strengths.
Stick to what you're good at. That seems to be the lesson for David Solomon, the CEO of Goldman Sachs there, speaking about the bank's first quarter results yesterday. Retail's gone, trading is back, the numbers reflect it, but is it sustainable? So we got Goldman Sachs yesterday. The numbers were good, recording a 28% jump in net income in the first quarter. Now we get Bank of America, now we get Morgan Stanley. Kind of, is there a read across? What do we learn from JP Morgan? Jenny Soren joins us now to talk about this. Let's start with Goldman Sachs. Stick to what you're good at. You're very good at trading, clearly. Retail, less so. Is Goldman Sachs back, and is it sustainable?
I mean, I think that's definitely the message from yesterday. So, yeah, when you stick to your knitting and you stick to what you know best, the results look really good. I will say this is an environment that kind of plays to those strengths. So, especially when you look at how JP Morgan performed on Friday, this is a bank that has been, quarter after quarter notching just huge gains in net interest income. Now that rates are poised to fall, that's a business that kind of gets on its back foot. And so you start to look at things like trading, investment banking, capital markets origination. And so I think that's what you see here just even more clearly is, Goldman is a bank that kind of does well in that environment. And so you really see that divergence between these two banks.
Jenny, what kind of precedent does that set for Bank of America, for Morgan Stanley? You made the comparison with JP Morgan earlier. How much of this story is a Goldman story as opposed to a banking story?
I mean, I think it's a really good question. It's definitely a great day to look at it because Bank of America obviously is very similar to JP Morgan. They rely very heavily on their consumer banking arm. Net interest income has been a huge win for them these past couple of years. And so it'll be interesting to look at how they compare to Morgan Stanley, which is definitely much more like a Goldman type Wall Street focused bank. And so I think, later today when we get those results, you'll probably see that same divergence that we've been seeing so far this earnings season. But it also will be a good tell as to whether or not, Goldman's results on trading, is that really kind of that Goldman magic that they like to think they have? Or is that, something that the entire industry is kind of benefiting off of as, volatility kind of ticks back up here and folks are really keeping an eye on what the Fed is set to do.
Jenny, great stuff. Thank you very much indeed. Looking forward to the coverage a little bit later on. It's going to be fantastic. Shanali, etc., the rest of the team really delivering a little bit later for you as we work our way through these numbers on Wall Street. Let's turn to the big story that's coming up a little bit later on here in Europe. LVMH sales and revenue is going to drop a little bit later on. Expected maybe to be a little bit muted. China's going to be really interesting to hear to see how the Chinese story is developing. Is that the driver here, one way or the other? Well, let's figure out exactly what we should be expecting. Andrea Felstead from Bloomberg Opinion joins us now. Andrea, we saw a warning a few days ago from Kering. Hermes is absolutely flying. Which one is LVMH? Is it Kering or is it Hermes?
I think it's more like Hermes. It's less like Kering. That doesn't mean it is Hermes.
Yeah. Okay, so in terms of what we're expecting later, what are we looking at?
Analysts are expecting about 3% organic growth for fashion and leather goods and group overall. Now, this time last year, first quarter of 2023, both of those were in the high teens. and they were about double what analysts expected. Now, we're up against very strong comparisons because this time last year China was just reopening, the US was starting to slow, but it hadn't really turned down. Now we're looking at a much lower figure. If it is around 3%, I expect it will beat slightly. That will be the lowest since 2016.
Andrea, there's a lot of gloom and doom, it feels like, around luxury broadly, but LVMH in particular, and yet you're seeing the stock move over 20% since the start of the year. How do you square that?
I think analysts and investors got too excited. Bernard Arnault said in January that we were seeing a gradual deceleration, a normalization in demand after those 3 blockbuster years, rather than falling off a cliff. Investors who had sold the sector on weak earnings last autumn rushed back in, but I think it went up, too fast, too soon.
In terms of the China story, we've seen Chinese retail sales data today. They don't look great. The Chinese consumer is struggling right now. There isn't the travel that there once was. Is China still the swing factor when it comes to a set of numbers from LVMH? Is it going to be the swing factor this time?
It's going to be both. I think it's going to be China and the US, because the US has become a much more important part of luxury. So you've got those two engines. The idea was the US would slow and China would pick up the bling baton and run with it. And that hasn't happened. So what you've got both of them fairly muted. So that's quite a tricky situation for the groups to be in.
Andrea, are we watching at all this kind of flipped mentality? You were talking about this kind of American slowdown. You're seeing American resilience instead. When does that show up in these numbers?
I don't think it's yet. Investors really are looking for the US to rebound this year. And as you say, there are some quite good signs. Luxury demand tends to be more correlated with stock markets, and also in recent years, crypto. Both of those have been pretty good. We've seen prices on the secondary watch market stabilize. That could be an indicator. So definitely the US is the big swing factor. It's stabilizing. It hasn't yet recovered.
Andrea, we'll look forward to the numbers a little bit later on. I know you're going to be writing some fantastic pieces for us to read on the back of it. Bloomberg Opinions, Andrea Felsted. Quick look at the markets. This is what equities look like this morning. It is a negative session thus far. We are certainly pricing in yesterday's Wall Street sell-off. Equity markets have had a great run, though, so I think you've just got to see this in the perspective of what we are looking at here. But certainly some pressure being put on European tech stocks this morning. European luxury stocks are under pressure as well. So that is where we are seeing some of the weakness coming through. In terms of the bond market story, we're looking at yields going higher once again in the United States. They are fairly flat here in Europe, so that's another factor you need to think about. But in terms of what we are watching this morning, I think you kind of need to think about the reset for the rest of the day. What is it going to be? What are we looking at here? Is it just a kind of little bit of repricing? When does the market look forward and reprice maybe a more flattish session in the United States a little bit later on? We'll talk about that next. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife.
And, you know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The deal?
The Deal. The Deal. That deal. The Deal.
Huge deal.
Who dug this up? One of y'all's in trouble.
Wow.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
Let me just start with, this is not the first time we've heard this argument.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Morning, folks. 30 minutes into the trading session. Tuesday the 16th, turning out to be fairly ugly from the get-go, really. I think we knew this was going to happen. We saw what happened yesterday stateside. It's one of those mornings where you feel you need to stand up. So that is what I'm doing. So I'm going to talk you through what we're looking at here. It's a pretty consistent picture. FTSE, DAX, CAC, all down, let's call it 1.2, 1.3% across the board this morning. There's very few sectors in positive territory. Telco sector is one of those that is rising, but pretty much everything else is in negative territory. You've got some big names that are putting on some fairly decent-sized losses first thing this morning. Now, what is interesting here is that US futures are fairly flat right now. So at some point, Europe's going to get through the pricing of the session yesterday and start looking forward to the rest of the day. When does that happen? I think is going to be an interesting story. We'll see what kind of the early indications look like as we start seeing desks filled on Wall Street. So that's the picture at the moment. DAX is down kind of 1.5 now. FTSE's down 1.3%. So we're getting a little bit more negative. So let me show you the two-day chart. I show you the two-day chart, of course, because I want to show you what the gap looks like first thing this morning. And you can see that gap there. We were trading softer into the close yesterday, but that's the repricing versus Wall Street that we've had to do this morning. Critically, we are below 500, so keep an eye. That's been a kind of important line that people have watched out for now trading 499 on the stock 600, and we're down by around 1.2%. There are some single stocks that are actually looking a little bit better, Critty, and it's probably also worth taking a look at what is happening with the bond market.
Yeah, it is. I'll pick it up from here. When you look at the bond market, though, it feels a little bit more sanguine than perhaps some of the kind of pain you're seeing in the equity market. Let me walk you through it specifically when you look at the German yield picture, for example. Unchanged. France, unchanged. Italy, even, the kind of volatility you traditionally see in the periphery, not really showing up there. You are seeing a little bit of a pickup in the gilts market, but again, not one to write home about. That largely a reaction to what you saw with that stronger wage data as well. But again, let's bring it back to the equity market, because again, to your point, that's really where you're seeing the sell-off. There are some big stories to be watching, though, and Ericsson, I think, tops the charts when you talk about which ones are really worth watching. Ericsson kind of having a little bit of a mixed message here. They came out this morning and actually said their earnings weren't that great in particular. When you look at the profit numbers, they came in stronger, so their margin improvements are better. But in terms of the overall sales, their overall kind of units, that's where you see the demand drop. In fact, they talked about a 27% slump. They had that issuing a little bit of a forecast that is a little bit negative, but it's that profit improvement that's really helping investors get to about 5.8% increase in the stock this morning. I was sad to say that's the only green on the screen you're seeing this morning, kind of in line with what Guy was saying. Let's talk about the UBS story, down about 3.4% this morning. And this, of course, coming off the idea that they are expecting more kind of capital expenses. And that's really starting to see a hit there. A capital hit of as high as $25 billion, according to one Swiss minister. So seeing a big move there as well. Doc Martens is another one that we keep an eye on very, very closely. And those shares down a whopping 28%, hitting a record low. And that, of course, coming in a profit warning as well. It's that forward guidance that really matters, saying is we're going to see a challenging 2025. And lastly, Wise, this is the one that Joe Easton, our equities reporter, was talking about earlier. They're coming out missing their revenue estimates, their income guidance coming a little bit higher. They're seeing those interest rate growths. The customer growth is helpful, but ultimately, net, they did not meet the line the analysts set out for them. Those shares down about 8%, Guy.
No soft landing for Airware. DM down hard this morning. Kriti, let's talk about the wider market story now and get some perspective on where we're going from here. Maria Veimana, head of equity research at State Street Global Markets, in London today. Very nice to see you.
Very nice to be here.
Yes. You've been talking to me over the last few months about your strategy, and I'm wondering kind of how it now stacks up against a world that feels like it's changing a little bit. You've been long cash, you've been long tech. How do you think about that trade this morning in a world where maybe yields are going towards 5%? Looks like we're going to get no landing, certainly in the United States. Is that still the right trade?
I mean, the reason we liked cash and tech was really kind of this economic scenario when we have no lending. But I mean, to us, no lending means no lending and then crash. You still need to lend the plan. You run out of fuel. And I think we're beginning to see this kind of non-lending story. And bond yields are rising. So, I mean, stocks really don't like it. And so cash part of the story is helping. I mean, we still think tech is good because it's still one of very, very, very few areas where we can have earnings growth. And I'm sure we'll ask me a lot of questions on earnings, but looking at earnings expectations, it's really tech. We have something. So to me, that's appealing. So cash and tech is a good combination.
Okay, so you bring up the earnings, so let's go there. The equity market's had a great run.
Yeah.
The headwinds are mounting. Geopolitics, there's a long list right now. Are earnings going to be a catalyst, or are they going to be a good enough catalyst to get us over kind of all of those other issues? What are you looking at?
I mean, I like to think about earnings as kind of macro versus micro. On macro level, and that's what we saw in Q4, earnings were good enough. In aggregate, earnings grew great. We're not in recession. But under the surface, it was just tech. And that's why tech managed to lead. So that's why large cap companies managed to lead. And that was the distinction, large versus small. Large companies are able to deal with higher interest rate. Their financing costs are a lot lower. They more diversified client base. So, and I think that would be, again, this macro versus micro story. So bigger companies, more stable earnings, more stable growth. They can deal with the difficult economic backdrop. Smaller companies really challenged.
Maria, how much of the moves that we're expecting, or we've seen at least in the last week, overnight especially, coming in the next couple of weeks, are really some sort of retracement, just taking a little bit of steam or a little bit of momentum out of stocks, as opposed to some sort of fundamental concern?
Yeah, I think, ultimately what's driving stocks in aggregate is this kind of volatility backdrop. For a long, long time, we had a very low volatility environment as kind of market believed in this soft landing idea that despite everything, we're still having interest rates being cut very soon in synchronized way. And then we have like economic recovery fairly soon. So that was the belief, and that kept volatility low. And market, it's really interesting over the last months. We had a lot of data that challenged that, but market was able to shake it off and kind of continue for fairly strong, fairly benign environment with momentum stocks leading. So for now, we haven't seen this kind of narrative. Maybe we're just beginning to see it's a little bit kind of questioned. But for as long as volatility stays low, stocks tend to do well and kind of on a macro level. Under the surface is a different story.
Maria, how does that break down regionally, for example? If the United States is setting the precedent, or these kind of catch-up trades, for example, that we're seeing in Europe, is there some sort of capital flows or fund flow story you're seeing from Japanese equities, for example, to other parts of the world?
Yeah, for us, U.S. is still by far the best market because, as I said, we love large cap quality stocks. They tend to live in U.S. So that's positive story. We worry that momentum stocks will really struggle in in an environment where economy is slow, so that's definitely not Europe. Japan is big question mark. It's obviously been supported by weaker yen, but if that support going away as BOJ is getting more active, then we'll start questioning that more. Emerging markets, they don't look particularly attractive if we think that recession is coming. So it's still, I mean, we're kind of stuck with US and few kind of select countries, but there are not many.
Am I hedging the upside or the downside at the moment? What am I doing?
Well, cash and tech.
Well, yeah, okay. So that's the trade. But essentially, the VIX is picking up now.
Yep.
If I look within the skew, what kind of it looks still, it's become a little bit more balanced. It was very much people hedging the upside.
Yep.
Does this feel like a nervous market right now? You talk about sort of volatility. We're at 19 on the VIX right now. We've been much higher than that over the last few years. If you're looking at the options market, what are you seeing and what do you think you do?
I mean, I always want to hedge downside, especially if it's that cheap. Why not?
But the trade it's been the FOMO trade. It's been hedging the upside that most people have been doing recently. If you look at the skew.
Yeah. I don't know. I worry about recession a lot more than others, I think.
Yeah.
So
and how close do you think that is? You talked about the kind of running out of fuel and the hard landing. I was talking to Mark Cumber about this a little bit earlier on. It feels like we're getting into the no landing, hard landing scenario. But we were talking to Christian Muller-Glissman. He was saying that this phase could last quite a long time. So how long do you think this phase lasts for? And and this really goes to kind of why I'm asking about hedging the upside and the downside. How long do when do I alter that mix in terms of at the moment I'm looking at a fairly kind of decent market that could potentially go up for a little bit longer, but I'm kind of wondering what the timing, the tactical trade looks like around.
Yeah, I think it's a brilliant question because I think part of the economy is already in recession and there are parts of the economy that are not. So being kind of equity analyst is actually brilliant because you can kind of do both. So it's difficult to do on an index level, but if you're looking at like sectors and styles,
so how would you do it below the index level?
I mean, large cap versus small caps, that's the easiest trade.
Right.
Obviously, small caps have been really struggling. And actually, that's the question I get asked most often. Do I buy small caps? They're so cheap.
Yeah.
No, don't. Because if recession is coming, that's a place where most pain will be. Do I buy value or growth? Do I switch? Do I buy cheap stocks? No. It's really difficult for a strategist to come to a client and say, no, stay with expensive momentum stocks. But I think that's the trade. You have to stay with companies that are able to produce earnings. It's quality. Yes, it's expensive, but at this stage of the cycle, you absolutely have to pay for it. And so that's your recession trade, ultimately, because you're buying expensive quality, right?
Yeah.
You wouldn't be buying it in normal time.
How long do you think this last phase lasts for?
Until we get into the recession.
How much fuel is in the tank? How much fuel do you think that? How much the US consumer looks like still very risk on, wants to buy stocks, wants to be risk on, wants to go out to the shops and spend money. How long does this? I remember the build up to 2000. It feels different but similar, and I'm wondering kind of how long this last bit lasts for.
I mean, it can. So the things I'm looking to kind of answer this question is bank lending. So we know C&I lending, that's negative growth already for a couple of months. If you look at consumer lending, I mean, one of very few places where consumer can borrow is credit cards at 20+% interest rate. So to me, that doesn't sound like it can last long.
No, that's a punchy number.
Yeah.
Okay. Well, certainly at the moment they may be willing to take that risk, but with the employment story as it is.
Exactly right.
Maybe we'll see.
Yeah, exactly.
We'll see how that. Lovely to see you in London.
Yeah,
come and visit us more. It's nice to see you in Milan, but it's nice to see you here as well.
Absolutely.
Maria, great stuff. Maria Vetmana, Head of Equity Research at State Street Global Markets. Thank you very much indeed. We need to talk about the China story as well this morning. You got to remember that the German Chancellor Olaf Scholz is out there. He's been meeting the Chinese President Xi Jinping. Apparently a tough line taken on trade. The Chinese economic data this morning also fascinating. We'll deal with all of that next. This is Bloomberg.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
Tuesday the 16th, 45 minutes into the session, this is what the equity market looks like here in Europe. As you can see, fairly negative picture. We priced in a little bit at the back end of the session in Europe. When I say pricing it in, we priced in the US sell-off, kind of back end of the European session. We had more to do this morning, which is what we've done this morning, and that is why you're seeing the red on the screen first thing today. It's been around the Euro Stoxx is down 1.4, Australia was down by 1.5, FTSE's down by 1.3, SMI's down by 1.2. Names like Nestle may be providing a little bit of support for the Swiss market this morning. Widening the lens a little bit, we probably should talk about what's been happening in China overnight. The Chinese data wasn't particularly good. The GDP number initially looks good, but it's kind of veneer thin in terms of what it tells you about what's happening below the surface. Take a look at what's happening with iron ore this morning. Take a look at what's happening with retail sales as well. And it's this kind of economic weakness, which is the backdrop that Olaf Scholz is facing in his trip to China. The German Chancellor is there. He met with the Chinese President, Xi Jinping, a little bit earlier on. Now, we've obviously got these trade tensions mounting, and the backdrop to that is the data we're seeing out of China. China desperately wants to export its way out of that slump, but we've got to talk about what is happening with the geopolitical story as well. Let's talk about all of this, bring it together. Ollie Crook joins us now from Berlin. Ollie, what can you tell us about the tone of the conversation between these two a little bit earlier on? We saw a very tough line being taken by Janet Yellen a few days back. Is Scholz mirroring that, or is the line a little bit softer?
I think it's a little bit softer, Guy, but I think tone is the right kind of terms in which to talk about this meeting, right? Because on the one hand, Germany is in some sense the strongest ally, certainly economically, to China within Europe versus at many of the other European countries, but at the same time, so acutely familiar with the risks of being over-dependent on another economy, let's say Russia and Russian gas, and really challenging the kind of the hallmark of economic and diplomacy of Germany under Merkel. You know, we're far from the change through trade days that we used to see, where you had really exuberant conversations with executives going to China, big smiles. This was much more somber. I mean, the tones, and if you listen to some of the readouts from the conversation, Scholz saying that both China and Germany are trading nations that benefit greatly from the World Trade Organizations. They're committed to strengthening rule-based system, right? And then Xi on the other side saying that as long as we have principles of mutual respect and search for common ground, despite differences, we can continue to develop this relationship. That is not really very sort of warm language, but it's saying, sort of acknowledging the reality that we are dependent on one another and we would like to continue to benefit, but maybe not as previously at the exception of political goals.
It's interesting, some of the kind of the numbers, the currency all starting to sort of look like actually kind of that initial entry into the WTO that China made all those years ago. Let's talk about the kind of the rules-based system. The Europeans are clearly very nervous, as are the Americans, about what is happening in key sectors. We're seeing investigations in Europe. We're stepping up those investigations into a range of subjects, including the auto sector. What are the Chinese looking at in terms of how those investigations are going to develop, and what did they do about it?
Yeah, guys, so what's really interesting is obviously the EV one is certainly the most significant one in terms of the economic impact, but you have other ones that have been opened up by Europe, right, into wind energy, into solar energy, where basically the industry in Europe has died for the second time because they basically have been outpriced and outcompeted by China. And what Xi Jinping will say, I'll read a quotation from what he said exactly this morning. China's export of electric vehicles, lithium batteries, and solar products have enriched supplies to the global market, relieved pressures of inflation, as well as made great contribution to global efforts to climate change and the green transition. So really the way that China sees this is, listen, we got ahead of this. We got a raw material policy in order. We've got all of these sort of things aligned in order to do it. Europe is obviously saying you're doing it unfairly, too many subsidies, too much of a tax break. But the issue that Europe is going to encounter is, a question of consistency. I mean, there's the Inflation Reduction Act in the United States. Are there no problems there? Does this sort of feel a little bit, biased? And there's a question of how much of it is legitimate competition, how much of it is unfair competition. And then the last point, Guy, and this is going to come into focus later this week with EU leaders meeting in Brussels to discuss this exact problem, European competitiveness. How can Europe become more competitive on its own? It needs to get that. It needs to get that in order itself.
All right, Bloomberg's Oliver Crook in Berlin. We thank you so much for walking us through some of the conversations that are going to be between Germany and China. But I want to continue that conversation because I really want to hear the European perspective. It's simply from the folks that are actively working on it. I'm very excited to bring in a special guest. We are now joined by the Director General of Business Europe, Marcus Beyer, joins me right here in Brussels. Marcus, we were just talking with our kind of European correspondent, Oliver Crook, there about what this threat looks, what from a geopolitical, from a kind of policy perspective, Olaf Scholz and Xi Jinping can potentially talk about. But from your perspective, you work with so many businesses, you advocate, you consult with some of the folks at play. What is the threat you are seeing? Can you kind of quantify that for us?
Well, I think the issue is that Europe is still leading in many aspects, like we're still leading in high-tech exports. But the truth is also we have been falling behind these last years, and you can see it in all figures. I mean, we have a weaker growth than the US or China. I mean, we have a low productivity growth. We have less industrial production development, and we have also a reduction in jobs in industry. And there's reasons for this. We ask our members, where is the reasons? And the main reasons they give us is the high energy cost, the cost of energy, which is comparably too high to our competitors. And the other aspect is regulatory burden. So meanwhile, we talk a bit like of a regulatory inflation or a regulatory tsunami. So there's a couple of things we'll need to do to bring the continent back on track. We think it's totally doable, but it's time to wake up and time to do our homework.
But what are you addressing specifically? Is this a China thing? Is this a United States thing? Are we waiting for election risk? Where's the threat coming from?
Well, I think, of course, the world has become a much more competitive place, and the fact that there's so many geopolitical tensions is certainly not conducive for a business model like the European one. Yeah. But I think the main point is that we have not done all pieces of our homework. I mean, we have done all kinds of things and might have lost a bit the view on the necessity to stay competitive, and of course the necessity to make sure that our economy stays strong, because Europe is always a strong player in the world when our economy is strong. And there's a couple of things we need to do. So we need to find answers to the too high cost of energy, going beyond what we've done so far, beyond the electricity market design. We need to reduce regulatory burden. There's first steps, but more needs to be done. We need to speed up our permitting procedures. I mean, our companies tell us, even if there's money, it simply takes too long to get the production site on stream or to have infrastructure done. So there's a long list of things which need to be done. The European Council, the politicians start to address it. They talk about the new European competitiveness deal this week in the Council. That's a good thing, but it can be a first step into a new phase of working in the direction of bringing the continent and the economy back on track.
For a global audience, we should mention that the noise you just heard was a little bit of drilling that we're doing, a little bit of renovation. But to your point, I want to bring it right back. When we're talking about what the hiccups here, it feels like capacity shortages may be an issue, specifically when it comes to how European companies can get access to things like raw materials in China, access to supply chains, access to even talent when it comes to things like technology. What needs to happen to ensure that that supply chain story, whether it's from a labor perspective or whether it's from a physical perspective, happens?
Well, the supply chains is a crucial issue, and having the critical raw materials, the metals, all this is key. So on this, we need to do a double act. So meaning we need to improve the capacities to mine and process in Europe. This is what we are doing. At the same time, it's very clear that the main chunk will stay imports.
Yeah.
So therefore, what we need is to diversify via ambitious free trade agreements and the free trade agenda, diversify, of course, our export markets, but also our import markets, and have raw material agreements with raw material-rich countries to have a choice.
But diversify with who? Because when I'm thinking of diversifying with raw materials, immediately there are a couple of names that come to mind: China, Russia, India, in terms of raw materials. Two of those three names, Europe is not exactly on great terms with at the moment, especially given some of the sanctions that are being put towards China. Obviously, Russia not being a part of the photo. Where do you kind of diversify? Where are those free trade agreements coming from in terms of raw materials?
Well, to give you an example, I mean, of course, Russia is a specific issue at the time being because there are sanctions and where the whole G7 is united to act in this direction. With China, I think Europe is working for a new balance, and obviously China will remain an important source. But there's other possible places, starting with South America. We have just more or less finalized our free trade agreement with Chile. I mean, this is very much about lithium. There's the Mercosur possibility, so South America is part of the answer. If I look at what comes from Russia, South Africa would be part of the answer, and I would say the more, the better. So we need a choice to avoid what we had in the past, that you exclusively depend on some markets. And of course, India is also something where Europe is negotiating. It's not an easy negotiation, but obviously this is something which would be certainly in mutual benefit.
Yeah, well, certainly something we'll be watching very, very closely. Markus Bayer, we have to leave it there. He, of course, is the Director General of Business Europe. Guy, talking to us a little bit about where these agreements are going to be coming from. How does Europe get competitive? A lot of it just comes from sourcing and alliances that are not necessarily traditional.
No, we've learned some big lessons over the last few years. Certainly Germany has, in terms of its reliance on Russia when it comes to that resource story. Kriti, looking forward to having you back in London tomorrow. Great work today in Brussels. Kriti, talking of Brussels, I just want to flag an interview as well, which I think you and many others will be paying attention to. Mairead McGuinness is going to be joining Bloomberg Television a little bit later on. Now, Mairead is the European Commissioner for Financial Services and the Capital Markets Union. The Capital Markets Union is absolutely pivotal now and being pushed hard. If Europe wants to finance the green transition, if it wants to finance the rearmament story, Capital Markets Union is being seen increasingly, and private capital is being seen increasingly as being hugely important. Jeremy Hunt is also over in the United States, and he's going to be joining Bloomberg Television as well. He, of course, is the Chancellor of the Exchequer. Today we see data that wages actually reasonably sticky, but the labour market is softening. What does that mean in terms of his party, his prospects going into the election? All of that is going to be discussed a little bit later on. Francine is going to pick up the baton from here. European equity markets are under pressure. The significant sell-off we're looking at this morning actually revealing some quite big numbers on the screen in front of you. This is Bloomberg.
Season 2 of The Circuit. We're walking with the titans of banking.
Hello! You guys love these meetings.
Yes, we do! And driving a warship through the Pacific.
You're not the typical Silicon Valley founder wearing a black turtleneck. Like, how does that play?
I am a little bit of a character.
Taking you around the world.
So we're
kind of in the middle of nowhere. It's incredible that this is the site of the biggest Netflix production ever in Latin America. And getting you closer to tech and business leaders like never before.
You have our money, you've got world leaders on speed dial. That's a lot of power.
Sometimes I think I'm just riding the Bronco and hanging out for dear life.
You driving a Hummer is pretty badass.
That's what I'm going for, like badass soccer mom.
I'm Emily Chang, your ticket to the front lines of tech, innovation, culture, and host of The Circuit. Wednesdays on Bloomberg Originals and Bloomberg TV.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
You were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
And market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter. And here's what's coming up on today's program. The dollar rallies against all of its G10 peers, sparked by geopolitical tensions and the prospect of rates staying higher for longer. Now, the latest data out of China suggests the economy is still struggling as the German Chancellor Olaf Scholz takes a tough stance in a trade meeting with President Xi Jinping in Beijing. Plus, Israel vows to respond with senior military officers saying the country has no choice but to hit back against Iran. Allies are urging restraint. So we have a lot of geopolitical news. Of course, that's playing out in the markets, but this is the picture overall for, of course, the European markets map. Now, what's moving these markets? Again, there's a little bit of a risk aversion out there. When you look at the FTSE, the DAX, the CAC 40, they're all down some 1.3%. In terms of asset classes, now the ones that we really need to keep an eye on, because we've seen a record high in a lot of these markets, is, for example, gold. We are also starting to get into earnings season. Again, I know that was fast. It feels like it was only yesterday that we had earnings day in, day out. But again, this wall of worry is really also following the sell-off that we had in Asia. And this is, again, a little bit of anxiousness out there about these elevated U.S. interest rates, but also signs of fading momentum in China's economy and these rising tensions in the Middle East. Now, S&P futures doing a better job at the moment of staying calm. The NASDAQ futures practically unchanged, but you can see really there is a bit of a sell-off in Europe. Gold is always, for me, a very interesting bet because sometimes it's counterintuitive. This used to be a play, almost a pure play against inflation, 2,367, and then you can see Brent at 90.19. So European stocks tumbling today following the sell-off in Asia. Again, U.S. rates, the worries that they remain higher for longer, adding to the gloomy mood, signs of fading momentum in China's economy. So let's bring in our guest, Emer Walsh, Mercer's head of investments for Europe. Emer, thank you so much for joining us. I mean, today's not a great day on the markets, right? Because there's a sentiment that creeps on grasping with basically a risk-off because they worry about interest rates, and there's this worry about geopolitical tensions.
Yeah, so I think geopolitics and market fall is front of mind for all investors at the moment. From our own perspective, that short-term volatility isn't creating huge concerns. We've seen red across the board, but what we're really focused on is what's going to happen to inflation. So all eyes are on that oil price, any supply shocks. Markets do not handle inflation spikes very well. You saw 2022, dismal for equities and bonds. So that's what I think clients are most concerned about. Are we going to have a repeat of that? Is this geopolitics going to drive inflation?
But I mean, inflation, and it's quite difficult to get a handle on, right? We saw in the markets has seen this like huge volatility because of what we saw in the Fed and that inflation handle. Like, how do you read and look at inflation?
Well, so from an inflation standpoint, the Fed will look at it in different ways. The Fed is all about data. The Fed and ECB are all data focused at the moment, and inflation is really going to drive what happens to interest rates. So from an interest rate perspective, if they see inflation ticking up, CPI, etc., no matter where it's coming from within the inflation buckets, that's going to really impact what happens to rates. So I think this market volatility, the VIX is up, inflation expectations, if they start nudging up, and in the US, that has happened over the last couple of months. So the Fed is stalling slightly, and I think they're going to even be more cautious looking at those inflation numbers and then what happens to rates, both in the US and in Europe.
Emer, so what do you, I mean, one of the other things we're trying to explore, and again, it's, I guess if there is a higher for longer interest rate, and even if the ECB goes first, then Europe will probably be hit the most, and you're also having this gravitational pull towards the Fed. So what does it mean for companies?
So I think from the European perspective, the ECB is going to be focused on, one, what's happening in the Middle East, that knock-on impact on oil, etc., and inflation. But also they're thinking about, okay, if they do cut rates, that's going to impact the euro. So that will essentially be almost importing some inflation into the Eurozone, into companies, and that's going to impact growth. So it's all very secular. So it's, I think companies are going to be under pressure on the inflation side if that does start to tick up, and if we do have higher rates for longer. So, you know, the market is pricing rate cuts in Europe in kind of June, July time. But, you know, I think with this volatility, they're going to be, you know, very cautious on taking a stance, particularly relative to the Fed. You know, they said they're data-driven, not Fed-driven. I love that phrase. But I think it is, they will be really conscious of the currency impact at the moment.
I mean, aren't we all Fed-driven? That's kind of like, I mean, I want to be data-dependent, but actually, again,
it is, you know, the global impact is
so
huge.
Big.
Yeah,
I mean,
exactly.
China's also quite difficult to read. I don't know if that's, you know, deflationary forces longer term, or whether they actually open up and start spending, and so that helps the rest of the world.
Yeah, so China is an interesting one, and I think what happens later this year in terms of US elections is really going to unfold the story with what happens with China. You know, trade wars is going to be a huge concern if that transpires. You know, you've seen the recent meetings with Germany and China. Everyone's focused on that trade dynamic. And China is a big partner of Germany, so everyone has to manage these conversations very delicately, which is being done. But there would be concern with the US that, you know, if they take a stronger stance on import tariffs, etc., that could create a lot of instability for China. So it actually could be inflationary, to answer your question.
Emer, thank you so much. Emer Washler from Mercer comes back in a moment, but also we were just mentioning President Xi Jinping has met with the German Chancellor Olaf Scholz in Beijing. The visit comes as tensions between China and the West mount over trade issues and the war in Ukraine. Well, earlier, the Chancellor warned Chinese officials to address overcapacity and treat foreign firms better. Let's bring in Bloomberg's Jill Dices with the very latest. So, Jill, good morning, or good afternoon, actually, where you are. How has Xi responded to criticisms of excess capacity in China?
So, Francine, we've actually seen quite a bit of pushback from Xi on some of these concepts here. The big thing that he really communicated to Scholz in their meeting this morning, it seems, was that China actually has helped lessen global inflation by through its exports of a lot of clean tech products. In particular, he focused on lithium batteries, solar panels, that kind of thing. So he's actually saying that really a lot of China's exports on this front have been a really good thing for the world. Again, lowering global inflation, also help contributing to green energy projects worldwide. So we're definitely seeing that bit of Xi Jinping really sort of hammering home this idea that you know, China wants to fight back against these claims that it's you know, it has issues with industrial overcapacity, not just from what we've seen out of Scholz during this trip, but also what we saw out of U.S. Treasury Secretary Janet Yellen just last week.
So, Jill, what can we expect in terms of, you know, more, I don't know who the next official to go to China is, but what's China's policy right now in how they're approaching Europe, given what's at stake with the U.S.?
Yes, well, Francine, I think there's a lot on the line when it comes to this relationship with Europe. Obviously, the Germany relationship is one that's critically important. China is Germany's most important trading partner, and there's a lot of concerns over, say, probes into certain things involving China. I mean, we know that, the European Union is probing subsidies for electric vehicles from China. In particular, Bloomberg also reported this week that another potential probe could be launched later this week, involves medical procurement devices involving China. So there's a lot of tensions as it comes to China, because this could obviously result in higher tariffs on Chinese goods. We know that the U.S. is looking into these measures as well as we gear up, especially for the U.S. election later this year. I mean, Donald Trump has said that if he's elected again, he could potentially be floating tariffs as high as 60% on Chinese goods. So there's a lot at stake in these relationships going forward. I'm sure China will be looking out for any of these further visits to try to temper down some of these really these big concerns around geopolitical tensions right now.
Jill, thank you so much. Jill Dice is there in Hong Kong for us. Now let's bring in back Eimear Walsh, Mercer's head of investments for Europe. Eimear, we were talking a little bit about the markets today, which, simply put, strong dollar, firmer treasury yields, weaker stocks, higher VIX. Does multilateralism actually hurt inflation? Again, because we're in this fractured, fragmented world, what does that do to your, what your take on European inflation is?
So I guess from client portfolio perspective, we are thinking about inflation and the damage it will do potentially over time to their investment objectives. But what we think will navigate that to the best extent is more diversification across asset classes. So back in 2022, bad year for equities and bonds. So 60-40 portfolios really struggled back in 2022. So having that diversification in portfolios is critical, and I think even more so at the moment. So not only equities, bonds, alternatives, private markets, that's an area that has a huge focus at the moment. And a lot of clients, they are accessing that return, that liquidity, that illiquidity, and also just benefiting from their overall diversification in their portfolio. So I think diversification is kind of our response to navigate those inflation challenges. And I know private markets, the IMF came out recently and talked about, potential systemic risks, et cetera, associated with it. But there are nuances to the asset class. But I think overall, particularly when this inflation spikes, it plays a really strong role in the portfolio.
Eimear, thank you so much. Eimear Walsh from Mercer stays with us. Now, coming up, Israel vows to respond to Iran's attack over the weekend as the West calls for restraint. Details next, and this is Bloomberg.
In tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg. Bloomberg.com webinars.
So the U.S. House is set to vote separately on new aid to Israel and Ukraine this week following Iran's missile and drone attack over the weekend. Meanwhile, top Israeli military officials reasserted that their country has no choice but to respond to Iran's weekend attack. Well, joining us now is Bloomberg's EMEA News Director, Rosalind Matheson. Ros, thank you so much for joining us. Is the risk rising of an Israeli strike against Iran?
Well, it's very clear from all the different officials we've heard from in Israel, right to the very top, is that they feel that they have to do something to retaliate against Iran for the strike that Iran did on Israel a few days ago, that they feel compelled to take some sort of action. The question, of course, is what does that action look like? There's a range of options for Israel that really kind of small and calibrated versus the sort of action that could trigger further reprisal from Iran. And then we're in this period of endless tit-for-tat attacks between the two countries, risking that broader conflict that everyone's worried about, that we're seeing being reflected in markets at the moment, FX, oil, stocks, everything getting jittery about the geopolitical outlook. And then the possibility of that wider conflict pulling in actors like the US. So really it depends on the nature of the response that Israel says it decides to do. But we can see from the rhetoric from Israel that despite the calls from the US and Europe for restraint, that Israel says this attack, unprecedented by Iran, from Iran straight to Israel, does require some kind of response.
But so, Ross, first of all, what could a potential retaliation look like, and where does that leave the U.S. that wants to try and de-escalate?
Well, it's possible that Israel opts to do something just in the cyberspace, which we might then not know about for some days or even weeks after. They might do something just in cyber. They might target one of the proxies for Iran in the region, so they might hit some of those proxy sites for Hezbollah, the Houthis, and so on. They might try that also in places like Syria. So there might be that kind of asymmetric response against some of those proxies. The big thing would be to hit Iran directly. Of course, Israel has done that before in the past, but in this climate, that's the sort of thing that would trigger a further response, and particularly does that include targeting Iran's nuclear sites, which is the ultimate one for Israel. But of course, what we've got now is the US urging caution. If Israel does go ahead, depending on the size of the response, that puts the US in a really awkward spot, because they are a key ally of Israel. They support it militarily, but they're obviously highly concerned again about the possibility of that broader conflict that would pull it in the Middle East.
So, but is there anything, Ross, actually, that the U.S. can do to, again, try and persuade Israel? Will the U.S. keep selling weapons to Israel?
Well, at this point, the U.S. has said that it will continue to support Israel militarily, and that includes sending it weapons and selling weapons to it. But we can see from the past couple of months that really Israel isn't listening to the U.S. anymore. We know that Israel did not tell the U.S. that it was going to, according to Iran, strike the Iranian diplomatic compound in Syria. The US got no advance warning that that was coming. We can see, despite the entreaties on Gaza, that the Israeli administration say that they still intend to go into Rafah in the southern part of Gaza at some point, because they say they need to try and eradicate Hamas in that area. And despite all those concerns, all those phone calls between the leadership of Israel and the US, Israel's been pushing on regardless. So again, what can the US do here for leverage? The big one would be to stop selling them weapons, but the US has made clear that they will continue to do that, at least for now.
Ross, thank you so much. Bloomberg's Rosalind Matheson there with the very latest, of course, on the Middle East. Let's bring back Emer Walsh, Mercer's head of investments for Europe. And Emer, this goes back to, the idea of how do you deal with all this geopolitical risk? Because it's extremely volatile, impossible, frankly, to price. I mean, worst case scenario, it is almost unthinkable. So what does it mean for investors?
So I think it is worth putting it in perspective. So for medium, long-term investors, we try not get too concerned about this short-term volatility. It's really about checking in on their overall portfolio, their overall strategy, making sure that they have the right diversification in there, both on the liquid and the illiquid side. On the liquid side, across regions, across sectors, different types of stocks, be that growth and value, but then on the illiquid side through the private markets and the alternative space.
Yeah, and the private markets, and this is the point that you were making, that actually the private markets are getting a lot more accessible. But with that, is it also more risk?
So what's happening in the industry is there is a democratization of private markets. So historically, this asset class has been reserved for the larger institutional asset owners because there's high barriers of entry. But actually technology and solutions, we're working with a lot of wealth managers on how retail investors can access through their products. So it's quite an exciting time because it makes it more accessible. But as you said, there are nuances and there are risks. And I think the biggest risks is, one, the appropriateness of the asset class. Is it right that investors go in there? And two, that the liquidity mechanisms are understood and appropriate for that client. So I think it's a great asset class, particularly to shield from short-term volatility, because pricing is lagged. You won't see the impact of this short-term vol on your illiquid or your private assets at the moment. Over time, it could feed through. But from an overall total portfolio perspective, it's really good to create robust outcomes.
I mean, is it, we're talking about higher for longer interest rates. So I don't know what that means for private markets, if this is, their moment where people go in, or whether actually you just wait a little bit to see where rates settle.
So from a rate expectation, a lot of people actually are concerned on the private equity side that higher rates will impact borrowing, will impact returns. But actually what we've seen in the past, if you look at the 2000s, there was high rates and there was actually record returns on the private equity side. So it's not at the point of entry, it's actually at the point of exit, which is really going to impact your return. And again, it's the diversification across private markets. So if you look at something like private credit, concentration is what's going to kill you in that asset class. You really need to be diversified across sectors, managers, year diversification. So I keep saying the point diversification, but in these market volatility times, that is what's going to protect the assets and withhold value in investors' portfolios.
But in private markets, is it a tougher sell actually in Europe because it's not as mature? The market's not as mature. It's almost much more nascent than it is in the US.
Yeah. So fundraising struggled last year slightly, and I think that's because of higher rates, and also a lot of investors were over committed relative to their target. But in Europe, it's a really growing area. We look at what large asset owners are doing and where their capital is flowing, and a lot of them expect to increase allocations to private debt, to infrastructure. There's a lot of interesting innovation happening in Europe, probably more in the US on the VC innovative side. As we mentioned earlier, Europe does need to invest in innovation to keep up with the growth projections that it needs. But I think Europe can do really strongly in the private market area.
Okay, Emer Walsh, thank you so much for joining us. She's, of course, from Mercer. We'll have plenty more of the day's top stories and interviews next. This is Bloomberg.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
My general advice is continue to seek out companies or people that are maybe 1 stage or 2 stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level up your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
Drew Baglino confirmed an earlier Bloomberg report about his departure. Now, their Vice President of Public Policy and Business Development, Ron Patel, also announced his exit. Tesla is looking to reduce its global headcount by over 10%, which could affect some 14,000 employees. Now, here's what we're looking out for today. 1:30 p.m. UK time, U.S. housing starts. 2:12 p.m. London time, U.S. industrial production. And then after hours, we have LVMH sales, and then later U.S. earnings from Bank of America, Morgan Stanley, United Health, Johnson & Johnson. And, of course, we'll have throughout the day some central bank policymakers. Coming up, plenty more. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The deal?
The Deal.
The deal. That deal. The deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Wow.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
The dollar rallies against all of its G10 peers, sparked by geopolitical tensions and the prospect of rates staying higher for longer. The latest data out of China suggests the economy is still struggling as the German Chancellor Olaf Scholz takes a tough stance in a trade meeting with President Xi Jinping in Beijing. Plus, Israel vows to respond with senior military officers saying the country has no choice but to hit back against Iran. Allies are urging restraint. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, the New York Fed President John Williams believes the U.S. Central Bank will likely start cutting rates later this year if inflation continues to gradually ease. Now, he also discussed resilience in consumer spending in an exclusive conversation with Bloomberg TV.
The consumer spending has been strong. I think it is driven by strong fundamentals. Job growth has been solid. We've seen real wage gains. We're in a pretty strong economy with good growth. So yes, it's part of that story. But I think what we're realizing is we're getting a nice tailwind from the supply side of the economy. Good labor force growth, strong productivity, good real wage gains. So with that, I think consumers are spending.
What's the thinking in your office and among your colleagues about, does this last, or is this a surprise that you think could go away at any minute?
Well, one thing that makes it really hard to forecast is we're still feeling the effects of the after effects of the pandemic and Russia's war in Ukraine and all the things that have happened in between. So we're definitely still seeing an adjustment process by the consumer, in the economy overall. But overall, I think that the economy will continue to grow at a solid rate this year. Probably not as high as the 3.1% we saw last year, but something like 2% or around that. So I feel like we're still in a good place. Probably not as rapid a growth as we saw last year.
You do have the strong growth. You have very low unemployment. Why cut rates if the economy is doing fine at this level?
Well, first of all, I think monetary policy is working at the rates that we have now. So I think monetary policy is in a good place. Over the past 12 to 18 months, we've seen pretty much all the measures of imbalances in the labor market and our economy recede, many of them back to levels we saw in 2018 or 2019. So we're seeing restoring balance in the economy. We are seeing a slow decline in inflation. So I do think monetary policy right now is in a good place. I'm not fixated on where do rates need to go, over the next year. What I'm focused on is how do we best achieve our maximum employment and price stability goals. The data we're seeing show that the economy is strong, and that's really good news, and labor market strong. At the same time, we are getting better balance, and we're seeing some decline overall in inflation. So for me, it's really about getting that right, and then whatever we need to do to adjust monetary policy, we can do to best continue the progress towards our goals. So that's how I'm thinking about it, and we'll just have to keep watching the data and make the decisions based on those goals.
Well, is your base case that you will cut rates this year?
My own view is I think that with inflation continuing to gradually come down, and I guess I would say gradually is the operative word here, and with the economy remaining strong, I do think that given where the level of rates are, real interest rates now are considerably higher than they were before because inflation has come down quite a bit. So we will need to start a process at some point to bring interest rates back to more normal levels. And my own view is that that process will likely start this year. But again, it's going to be driven by the data and achieving our goals.
Well, that was the New York Fed President John Williams speaking to us exclusively. Meanwhile, the San Francisco Fed President Mary Daly also reiterated there's no urgency to cut interest rates.
The worst thing we can do right now is act urgently when urgency isn't necessary. The policy's in a good place. We're in the ready position. We can respond as the economy evolves. The labor market's not giving us any indication it's faltering, and inflation is still above our target, and we need to be confident it is on path to come down to our target before we would feel the need, and I would feel the need, to react.
The San Francisco Fed President there, Mary Daly. Now, the dollar rallying against all of its G10 peers, sparked by geopolitical tensions and the prospects of rates staying higher for longer. With us now, Bloomberg's FX and Rates editor, Aline Oyamada. Aline, thank you so much for joining us. So the dollar up a fifth day, the longest winning streak since January. What's exactly behind the rally?
So like I said, it's all really playing in the favor of the dollar. You have this whole story of the Fed will take much longer to cut than initially thought. And it all started last week, remember, with that very hot inflation print. Then retail sales came. They were also strong. It all reinforced this new trader view. And then on top of that, you have geopolitical tensions, which are always kind of a boost for the dollar. It's the ultimate safe haven. So this is what we are seeing really now. No one really wants to bet against the dollar. And it's actually interesting that this is bringing up volatility to the currency market, which was dead for quite some months. Like we were all even discussing if that was the new normal for the currency market. So things are starting to pick up again.
So, Aline, I mean, this is quite painful for certain parts, especially like FX in Asia. What are we seeing there?
So in Asia, I think you have some very some kind of weak links. One is the yen. Obviously, it has been weak for so long, and we are just waiting for intervention for quite a few weeks now. I guess the big point there is when will they really step in and what will it take? We were watching that 152 level. We crossed that after CPI because it was very gradual. So now we are starting to see people saying, oh, maybe it's 160 or 155. It doesn't really matter actually the level, but as the pace of that move. And as long as it's driven by the dollar and kind of an orderly move, maybe they will just wait and see. And then you also have other stories in Asia, like the yuan, that China did a weaker fixing for the currency, and that also drove some negative sentiment in Asia. But overall, many EM currencies and even DM currencies have fallen to like the weakest levels this year.
I mean, I know there was so much focus on the yen. I mean, could there be some kind of, how much intervention are you expecting actually from central banks? And you put it correctly, a lot of the times it's not really the level, but it's the pace at which these currencies move.
Yeah, so it's really tricky. There's no, I think, estimate for how much they would spend because it would depend a lot on the speed. But what we hear is around the same that they spent last time. And then there's also talk about how they would combine policies to do that, obviously, because it's not just currency, not just stepping in and buying, but also like interest rates are a big factor. As long as interest rates in Japan are so low, you will always have people betting against the yen. So when will the BOJ move? And that's the biggest question maybe for the year also.
That is a big question. Aline, talk to me about pounds. So we're sterling obsessed. Like, what are you seeing there?
So the pound is another weak story in the recent weeks, but it's a slightly different one because it actually started the year very strong because everyone expected the BOE, because inflation in the UK is so high, the BOE would take longer to cut interest rates. And then it slightly changed a bit when we saw some softer prints, and then the U.S. were pricing toward fewer cuts, and now it's starting to look that maybe the BOE could move before the Fed. And this is obviously not good for the pound. And on top of that, we had the market super bullish on the pound. So some people started to say it's expensive, positioning was kind of stretched, and this is all kind of like gradually dismounting. And obviously the pound is feeling the pain now.
Yeah, and I don't know whether it complicates it for the Bank of England. I mean, if you speak to the governor, he says, no, we're not looking at the pound. You know, for that's definitely not my remit. But at the margin, it makes a huge difference for, you know, importing and exporting and therefore GDP.
Yeah, it does. It definitely has an impact. I would say at this very moment, it's not the most like crucial thing for them to watch because it is coming off a very strong level. So wages growth, like we saw today, which was above estimates, that's like those are the real things that they are really looking at and will make a difference in what markets are betting to.
Alina, thank you so much for joining us today. Alina Oyamada, there with the very latest on some of these big currency moves. Now, a reminder, we'll also be speaking with the UK Chancellor of the Exchequer, Jeremy Hunt, on the outlook for the British economy. That's just after 7 p.m. UK time. Coming up, we take a look at the rising demand for premium skincare with the global brand president for Clinique and Origins. That's next, and this is Bloomberg.
Season 2 of The Circuit. We're walking with the titans of banking.
Hello! You guys love these meet and greet things. How are you?
And driving a warship through the Pacific.
You're not the typical Silicon Valley founder wearing a black turtleneck. Like, how does that play?
I am a little bit of a character.
Taking you around the world.
So we're kind of in the middle of nowhere. It's incredible that this is the site of the biggest Netflix production ever in Latin America.
And getting you closer to tech and business leaders like never before.
You have our money, you've got world leaders on speed dial. That's a lot of power.
Sometimes I think I'm just riding the Bronco and hanging out for dear life.
You driving a Hummer is pretty badass. That's what I'm going for, like badass soccer mom.
I'm Emily Chang, your ticket to the front lines of tech, innovation, culture, and host of The Circuit. Wednesdays on Bloomberg Originals and Bloomberg TV.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West, only on Bloomberg Television. Context changes everything.
Now, the conversations that matter, the insights you need. This is a pulse, and I'm Francine Lacroix here in London. Now, skincare is a top revenue sector for Estee Lauder, reflecting rising global demand. Its Clinique division also debuted on Amazon as it seeks to redefine its brand for the future. Well, joining us now is Clinique and Origins Global Brand President Michelle Ferreira. Michelle, thank you for joining us. I mean, skincare, I don't know whether it's having a revival or certainly everyone's talking about where you know, this is where you can make quite a lot of money. There's a lot of also you know, companies trying their hand at that. Mm-hmm. What kind of growth are you expecting in the industry?
Yes, we are seeing very strong, healthy growth in prestige beauty around the world. We saw a huge acceleration of skincare growth during COVID. And consumers are more and more educated about their skin, and skin is now really more about skin health. And then post-COVID, then we saw a bounce back also to makeup, but makeup influenced by skincare. So we are seeing really strong, healthy growth, and we're really excited to see how consumers are just educating themselves more, and we in Clinique, education is core to the brand, so we really take pride in educating consumers about their skin health.
So, Michelle, I mean, Clinique is one of the names that everybody recognizes. It's been around for a long time. It generates quite a lot of revenue. What do you spend most of your time thinking about? Is it how you position it? So you talk about prestige, which is not quite high-end luxury, but it's kind of like prestigious. Is it pricing or is it distribution?
Yeah, no, Clinique, it's really more about the consumer. We're always thinking about the consumer, where the consumer is going. The space that's very much growing is the space with dermatologist brands. And Clinique was founded in 1968 by a world-renowned New York City dermatologist. Today, Clinique is still dermatologist guided, and we offer safe clinical solutions that deliver on the highest level of efficacy with the most rigorous safety, which consumers are really looking for.
But Michelle, there's so many new entrants as well. So
yes.
how difficult is it to actually fend those off? And does it really depend on how you position yourself? And so I know it's quite exciting that you're selling on Amazon. What was the decision behind that?
Yes, we are selling on Amazon. We just launched in the U.S. only. And that is really about expanding our consumer reach and making sure that we continue to speak to and appeal to broader consumers in the U.S. And we're doubling down on our authentic dermatologist heritage, and so consumers can come. We are launched on the Amazon Premium store, and so we have a branded storefront where you can come, you can get personalized solutions. We partnered with our guiding dermatologist to create a Clinique skin analysis tool where you can get personalized recommendations, and you really learn about the Clinique dermatologist guided solutions that we offer for skincare, but also makeup. So Clinique is the only dermatologist brand that offers makeup. We offer dermatologist developed foundations. We offer our eye makeup is backed by our eye safety promise, which means that all our eye makeup is safe for sensitive eyes, safe for contact lens wearers. All of that is on Amazon. You can learn about that.
I mean, it's amazing that actually you've decided to partner with Amazon. And again, is that because it takes away the pain of actually reaching consumers? Or were you ever worried, like, talk to me about the discussions, were you ever worried that by being on Amazon it cheapens it? Or are the benefits of actually reaching a wider, consumer audience 100% worth it because Amazon is also changing?
So Amazon has really evolved in the last few years, and so their premium store now allows brands to offer an elevated experience, which is really important to us, and allow for these personalized tools for education. So just the overall experience on Amazon is you're not compromising as a brand. You're able to deliver on that elevated experience and personalized recommendations that consumers are looking for. So it is a place where we felt like we could really double down on our authentic derm heritage and offer that to consumers.
So, Michelle, what's next for Clinique? Is it, I know you're also selling to men, and actually that demographic has really come on to skincare, which is basically untapped revenue. There's concerns that teens and tweens are starting into skincare. Like, how do you see that evolving?
Yes, definitely we see that. We take that very seriously. Safety is such at the core of Clinique, and we just make sure we have, here in the UK, we have 900 consultants. So we have, Clinique has consultants that are clinical consultants trained in partnership with dermatologists. So we make sure they're trained to offer recommendations for any age, any skin type, whether it's men, women, young teens, older women, which is really the beauty of Clinique, and we can offer those safe clinical solutions no matter what your age is.
What region is doing the most? Is there an appetite for skincare in a region that's going better than others? I don't know whether the U.S. is leading or whether, for example, it's in Asia, or how you see that changing.
Absolutely. I mean, the U.S. And the U.K. are core heritage markets for us, must-win markets for us. And then we're also seeing an explosion in Asia, in India, which are also markets that we are also scaling. But the US and the UK as our core markets remain must-win for us, and where we know that we can really truly serve the clean consumer.
Michelle, I imagine that AI plays a huge part in also being able to do all of this dermatology and skincare. I mean, is it really changing to the point where you buy a foundation online, it's the right color, and how much investment and how much attention are you paying to AI to be able to sell the right things to the right people?
Yes, I'm so glad you're asking that question because we are investing a lot of time in that. First of all, we're seeing sensitive skin is a huge global phenomenon right now. It's on the rise. 71% of consumers around the world say that they have sensitive skin. So personalization is more important than ever. And so we actually are rolling out right now an AI-powered diagnostic tool to offer those personalized recommendations. And what is so great about it is that it has 55 years of our dermatological science and research and the data of 3 million face evaluations that we've conducted over the years. So it scans your face, but it doesn't just take what it scans. It also then takes all that information of the 55 years of science with the 3 million face evaluations to give you the most personalized recommendation. You could do it on your phone, like go on our brand.com and do it. But if you go to the store, the clinical consultant who's trained on that partnership with dermatologists can also help guide you.
And Michelle, how sensitive are your consumers to price increases and price changes? So we're seeing cost of living pricing, we're seeing inflation, but I imagine your supply chains and your ingredients are also getting more expensive.
Yeah, absolutely. I mean, consumers, yes, as you say, are very sensitive, but it's really more about value versus price. And I think consumers are very engaged in beauty, in skincare, and so to them, they want approachable solutions, that are affordable, but it's about the value. So they want to still make sure that they're getting products that are from brands that they trust. They're willing to pay for that, and they're willing to pay for what they know is going to be good for their skin.
Michelle Ferrer, thank you so much for joining us today. That was the Clinique and Origins Global Brand President, Michelle Ferrer. Coming up, another big week for U.S. bank earnings with Goldman Sachs closing a little bit higher after posting a profit jump. We have Bank of America and Morgan Stanley still to come. That look ahead is next, and this is Bloomberg.
Names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on their phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide create index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
Let me just start with, this is not the first time we've heard this argument.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
The conversations that matter, the insights you need. This is a Pulse. I'm Francine Lacqua here in London. Now, U.S. bank earnings season continues. Bank of America, Morgan Stanley due to report later. Now, Goldman Sachs shares closed higher after the lender posted a surprise profit jump in the first quarter. Now, let's bring in Bloomberg's Jenny Serrain, who, of course, leads our coverage here of European banks. Okay, we're almost there. It's been like a big week for earnings. Goldman Sachs, much better than expected. I mean, was it all about trading, or what's driving this for them?
Yeah, I think, with the results yesterday, it was certainly all about trading. And so they beat on both the fixed income trading side and the equities trading side. And it just looked like a really all-around good quarter for them. If we remember, they're kind of going back to their roots right now. So they had this years-long foray over into retail and consumer banking. They're pulling back on that now. They're really focusing on what Goldman's known for. And that just really shined through yesterday, and the stock reacted accordingly.
And the chief executive, Dave Solomon, has been in a spot of trouble. Maybe that's the way to put it. Do these numbers really help him?
I think so. It'll be interesting to kind of see. One thing that we've been reporting a lot is they've had a retention problem. So they've really lost a lot of senior talent. They've seen a lot of partner churn. That's really unusual for a firm like Goldman. Historically, they aren't really seen as a place that kind of people shuffle in and out of. And so I think, when you've got results like this, it just makes that argument for him so much easier when he goes to these senior folks and says, no, believe in the cause, believe in the case, we're doing it, we're kind of making this progress that we need to make. So it should help him, but it's always hard to know if one quarter really makes a trend.
So today we also have Bank of America, Morgan Stanley. What are you most excited about? Morgan Stanley's quite exciting because you have a new chief executive in charge.
Yeah, no, I think it'll be interesting. So Ted Pick's first rodeo at the earnings front, or at least his first full quarter, I guess, in the seat. And so I think it'll be interesting to kind of see how he handles things. Maybe it'll be a little bit different from the way James Gorman historically did. Trading is such a hard thing to read across. So just because Goldman had really strong results there yesterday, it's hard to know if Morgan Stanley will show the exact same results. But I'm sure, with Ted Pick at the helm, he'll be looking to kind of point out all of the strengths that they've had in the last few months. So it'll be a good one to watch for sure.
All right, Jenny Serrain, on top of all of these earnings, and then it quietens down until we actually get into what's happening here in Europe with UK banks. So, keep on watching and following Jenny and her team's great stories. Now, coming up later today, the Bloomberg Technology team will speak to Merit McGuinness, the European Commissioner for Financial Services and the Capital Markets Union. So don't miss that interview. We have plenty more to come. Markets getting a little bit of a hit, certainly here in Europe. Now, if you look at what the worries are, first of all, there's U.S. rate angst. China's sluggish economy is also something that they're worried about. And then geopolitics back at the forefront with a possible Israeli counterstrike. So on the back of that, you can see gold 2,368 when it comes to U.S. dollar. We chose the Bloomberg U.S. dollar index 1264. Up next, to Bloomberg Brief, Danny Berger and Manus Craney have all of your stories from New York. This is Bloomberg.
So you've built a successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Good morning from our world headquarters in New York. I'm Manus Granny.
And I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Markets remain on edge after Wall Street's plunge yesterday. The dollar continues with dominance.
A mixed bag of China data adds to the broad risk aversion in the markets.
Plus, Morgan Stanley and Bank of America wrap up the earnings parade today of the big U.S. banks. So we are grappling with higher rates, geopolitics, China disappointing in the growth data for March. And how does that play out to markets? Well, as Danny said this morning, finally the equity markets are catching up with the bond markets. We had a pretty torturous day yesterday, down nearly 1.8% on U.S. equities. We're stabilizing ever so slightly this morning. But again, that yield spike at up 14 basis points at one juncture yesterday really infected a repricing in the equity narrative. UBS throws a wrench into the thinking that rates may well have to, or could possibly, there's a fly in a kite of 6.5% from UBS. What would that do to equities? Down between 10 to 15%. Suddenly, we need to understand, what will the reprisal be from Israel to Iran? They stand ready. The language, we'll play you the language a little bit later, but a more severe, a faster, a more immediate blow will be leveled by the Israelis on the Iranians. Take yourself to Europe. Europe and Asia and Australasia all playing the catch-up game with the sell-off here in the United States. So that's why it looks a lot more visceral in Europe relative to the rest of the board this morning. You're looking at the material producers are down because of the disappointing March data from China. So the materials element down 2.86% in Europe this morning. But Europe plays the catch-up to America's sell-off yesterday on the rates bounce.
Well, it might be a sell-off in American stocks, but it is the dollar, Manus, which is dominating. It's clobbering its way through all of the major currencies. It is stronger against all of them. Bloomberg dollar spot up 0.2%. The Bank of Indonesia had to step in after the rupiah fell to a 4-year low. The yuan, we also saw job owning there after hitting a 2-year low. EMFX is at its lowest levels of the year. It is dollar strength on rates, on geopolitics, on haven, and also China setting a weaker than expected fix this morning. Manus, you mentioned the yields, the jump yesterday, 8 basis points. We are up 43 basis points so far this month, the highest since November. It has been a huge climb. Brent crude takes a breather this morning after gaining. We're still at $90 a barrel, up 18% this year, even with a climbing dollar. So that is remarkable. But Manis, a lot of what's happening in Brent crude, of course, is geopolitics. But we've really been focusing on crude in terms of the fallout, not the wider markets. Sonia Martin of DZ Bank, who we're going to speak with later in the show, puts it really well that investors don't even want to imagine what the fallout is from risk of escalation, which is why markets have been calm. But once you look at the white of the eyes of the top Israeli officials saying we have no choice but to respond, it's not just imagination anymore, it is reality.
And here's the reality. It is the differential between the West, G7's understanding of what they want versus Israel and Iran. Two very different viewpoints. And if you look at the language from the deputy Iranian foreign minister, this is what he talks about. He talks about a more severe, faster, and more immediate blow. And it is the differential. If you look at what Macron is saying, we want to avoid flare-ups. So there is this chasm, and there always has been this chasm between the West and that of the Middle East in terms of a comprehension of what is needed to be delivered from both sides.
Yes, the rules of engagements have changed. It went from a conflict in the shadows between Iran and Israel to out in the forward. And despite, Manis, the U.S. and its allies, as you say, urging Israel to restrain from responding to the Iranian attacks, the Israeli Defense Forces Chief of Staff reasserted that the country has no choice.
We are closely assessing the situation. We remain at our highest level of readiness. Iran will face the consequences for its actions. We will choose our response accordingly. The IDF remains ready to counter any threat from Iran and its terror proxies.
Joining us now is Bloomberg's Golnar Motivali, who covers the Middle East and Iran. So Golnar, we had yesterday CNN reporting that there was a meeting of the Israeli defense chiefs, the cabinet. It ends, and they review options for a strike, but no conclusion as to whether or not they will do it. Where does the risk stand of an Israeli strike against Iran, and what might it look like?
Well, as you said, those meetings were inconclusive, and we've heard from the Israelis that they definitely have to respond, as we just saw from that clip from Halevi, from the IDF spokesman. And what I think that's where the big question mark is now: is Israel going to listen to these calls from the United States and the West and its other European allies urging it to act with restraint? And I think what we're seeing so far, I think, are some sort of notes that hint more to that. So we also had a spokesman, Peter Lerner, tell us on Bloomberg Radio earlier that Israel is going to act with patience and it's going to take its time to review all its options. And if you put that alongside the statement from the deputy Iranian foreign minister, Bagher Erekani, that you just quoted, you know, he's saying that we will act within seconds, we will strike stronger, more immediately, harsher. I think both of them, there's a sense there that neither of them wants a big escalation, but obviously Israel has to, or it needs to give the impression that it has to act somehow. I don't think it can allow Iran to set a precedent to hit these direct strikes. And at the same time, it kind of works in Prime Minister Netanyahu's favor and his very hardline Israeli cabinet to keep the world's attention away from Gaza, away from the massive civilian death toll that's been wrought on, the destruction that we've seen in that enclave. It suits them to actually keep the attention and the world's focus away from that. And
the next move by Israel, to what extent must that be verbally backed by Joe Biden, which he talked about an ironclad support for Israel? So whatever Israel does, it needs to be calibrated with a tacit support from the U.S.?
Well, that's also an interesting point, because we've seen the U.S., obviously, U.S. is a very, very staunch ally of Israel, and it has said that, as you said, it's the ironclad support for Israel's need and right to defend itself will always be there, and it will be steadfast. But they also made a point of saying that they won't support an offensive strike on Iran.
Yeah.
At the same time, you know, when it comes to it, we also saw on Saturday night when Iran did strike Iran that the US did scramble to its aid very quickly. And so maybe Netanyahu will choose to call Biden's bluff on that. And the US may be forced to actually, they have lots of assets, obviously, military bases in the region, to actually come to Israel's help and support if it does choose to strike Iran directly.
Okay, Golnar, thank you very much. We'll track the situation closely. Golnar Motovali there. Joining Danny and I this morning is Octavio Marenzi, co-CEO and founder of OpenMess. Octavio, good to have you with us. The world grapples with a lack of, I suppose, a lack of belief that we could go to an even higher escalation here. When you look at market reaction, when you look at the deep concerns of markets, what is your take over the past 48, 72 hours?
Well, I think my take is that the Iranian attack seemed to be very carefully calibrated, and they were very careful to only hit military installations. They looked to not cause any casualties. It seemed that they were very, very careful indeed about not escalating this any further. So it seems to me the Iranians have sent a clear signal they do not want further escalation. I think the Israelis in likelihood will not have too much of a response to this. After all, no one was killed. We basically shot down a bunch of different drones and things of that sort. So I don't expect to see too much fallout from this. I'm quite optimistic about that, far more optimistic than most of the pessimists are on this. I think this establishes a sort of a slightly new balance of power between Iran and Israel. Iran has demonstrated they can strike within Israel at will and hit almost anything they want there. So Israel's going to have to be very measured and careful in its response. And that might be a good thing to not escalate this any further.
Would you say then, Octavio, what we've seen from markets over the past 24 hours, one of a strengthening dollar, one of yields marching higher, that none of that is geopolitical risk, and instead it's simple and clear reaction to the fact that we are underprepared for a Fed whose next move might be a hike rather than a cut?
I've been talking about a Fed hike for some time now, and I've been very lonely on that point, and so I'm happy to see other people join me now a bit in saying that if you look at all the parameters, all the variables on a macroeconomic level in the US, they all indicate or point towards actually a rate hike rather than a cut. So unemployment remains low, GDP growth remains strong, the markets are at or near all-time highs, so that's we come down a bit now the past couple of days, but we're still pretty near that. So there's nothing really out there that would suggest a big rate cut is necessary. In fact, it looks the opposite direction. Core inflation is still twice what the Fed would like it to be. So I think all the indicators point towards a hike rather than a cut, or at least delaying the cut for as long as possible. So I don't expect to see any cuts this year. Maybe it's towards the tail end of the year, depending on what happens. But I think all the indicators point in the opposite direction, have been pointing in the opposite direction for some time now.
And that itself has really interesting implications for the bank. Some good if you're a large bank, some bad if you're regional. Octavio, stay with us because we're going to discuss just that. Octavio Marenzi of OptiMas. But first, let's get to some of the other stories that are trending on the terminal this morning. House Speaker Mike Johnson plans separate votes this week on new aid to Israel and Ukraine. The move could end a months-long Republican blockade on help for Kyiv, while also responding quickly to Iran's missile and drone attack in Israel. Johnson said, quote, "The world is watching us to see how we'll react," as he announced the plan.
Former President Donald Trump's first criminal trial got off to a slow start, with the proceedings stalling over disagreements about evidence and other last-minute arguments. The first day concluded with no jurors picked, and proceedings will resume today. Trump, who is accused of falsifying records to hide hush money, has railed against the case for months and denies wrongdoing.
Xi Jinping is pushing back against European and U.S. pressure to rein in the country's powerhouse industries. The Chinese leader told his German counterpart that a surge in Chinese clean tech exports has helped the world tackle inflation. Xi's comments to Chancellor Olaf Scholz during talks in Beijing suggest China may not be swayed in any meaningful way by the German leader.
Coming up, disappointing data from China.
And Morgan Stanley and Bank of America prepared to report before the bell after Goldman's strong quarter. We'll discuss with Octavio next here on Bloomberg Brief.
world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be
We're
important.
going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions. From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
Let me just start with, this is not the first time we've heard this argument.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything. Season is here.
I think we're all asking the same question.
Just how much earnings growth they're expecting.
Bloomberg is first to break the numbers.
Gilead just coming out right now.
We have Take-Two numbers.
Shares of Pinterest.
Lucid Group coming out with its earnings.
All eyes right now on NVIDIA.
A lot still to come.
With the smartest insights.
How much bigger could profit and revenue have been? Better than what the street was expecting.
Bang in line with estimates.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
It's Bloomberg Brief with Danny Berger and Manus Cranny in New York. Earnings season is kicked off with a bang and a whimper, I guess. The big banks have reported, and it was a bang for Goldman. It was a blowout quarter. And after them, it's time for Morgan Stanley and Bank of America to step up to the plate today. We're back with Octavio Morenzi, co-CEO and founder of Optima. So, Octavio, we had Goldman yesterday. Investment banking and trading was strong. The OG powerhouses of Goldman Sachs showed up to a big degree. Is this validation of Solomon's reboot?
Well, listen, they did well across the board. All lines of business were basically up, and even if you dig further down, everything was looking really good. I think it's still a long way to go back to the glory days, though. If you look at their return on equity currently, it's just under 15%. That's well below where it was at its peak, where it's sort of in the mid to high 20s. So there's still some way to go, but they're certainly on the right path. I will say about investment banking, we saw investment banking revenues at Goldman come up about 35% year on year in this quarter. But bear in mind, the past couple of years in investment banking have been pretty bad. So there's signs of life there. It's moving in the right direction, but it's still much, much lower than it's been historically. So I would say, yes, it is validation of Goldman Sachs' approach. It seems to be working. They have focused on the correct businesses and seem to be capitalizing on that. But their profitability is still quite a bit below where it was in its heyday.
In terms of the investment banking, the fixed income side, I mean, the news flow was good. It shows improvement, but the risk is that we started this year with such ferocity in debt capital markets, equity capital markets, IPOs and M&A. But the risk is with these geopolitical wins and with the Fed re-rating is that some of this momentum fades.
That's absolutely definitely a risk. So we might well see the IPO market dry up again if geopolitical risks come into the fore and the markets come back down. But so far, it seems to be holding quite steady. And bear in mind, there's quite a long runway before you take a company public, before you do an IPO. So basically, these deals start to come into the pipeline at least a year beforehand. So they're very reluctant then to pull them back. There's a lot of work and effort that goes into them. And sometimes these companies really do need the capital. So sometimes there's really no choice. You have to do something. You have to raise debt or equity or something to keep financing yourself. So I think, yes, we might see a bit of a pullback, but I think the investment banking activity looks set to continue. We've seen a lot of interest in mergers and acquisitions. Debt issuance remains surprisingly strong, and equities issuance much, much better than before.
Well, we really hear time after time, again, over so far, let's say this year, when Manus and I have conversations with people in private credit, that banks are coming and they're showing up in a big way, starting to come back from the market share that they lost, that these banks want to have a strong balance sheet that they can start investing from again. Octavio, is that trend real at a time when you also have increased regulation? Can the two of those coexist?
Well, I might take slight issue with the premise of your question that the banks have basically departed and were not lending that much. If you look at the overall balance sheets, certainly the US banks, they never really declined. So lending has continued to be very good and very
Octavio,
active.
they certainly have lost market share to private capital.
Yes, they've lost market share because other people have come in and started lending more. But it's not as if the banks pulled back. I mean, they're lending pretty much as much as they can. So there has not been a decline in bank lending overall. Other people have started to lend even more. And they've been drawn into the higher interest rates that they can get through private credit instead of investing in the public markets or buying bonds or things of that sort. So, yes, there's definitely been a reduction in market share. However, their absolute level has continued to increase, and increase perhaps as quickly as they're comfortable doing.
Octavio, today we get Bank of America. I'm curious, you say mortgage lending, which year on year is flat. I mean, some of the tail risks are beginning to become more manifest, which is mortgage lending, commercial lending, flat. How important is that to the Bank of America scenario?
Well, Bank of America is a very diversified institution, so it's got a very big wealth and asset management arm. It's got a pretty decent investment banking arm. It's a very well diversified bank, unlike someone like Wells Fargo, who's more exposed to mortgages. But we did see some positive activity on the mortgage front, mortgage origination as well at Wells Fargo. So I think if we look at Bank of America, I would expect them to follow pretty much lock and step with JP Morgan in the sense that they have a fairly similar exposure there. Now, JP Morgan did very, very well when it announced last week, but the stock price got clobbered for reasons I don't quite understand. It seemed that Jamie Dimon delivered a very, very good set of results, but the market just decided to punish him. But I would expect to see Bank of America follow very, very closely in terms of that. There might be some differences in certain lines of business, but I think the overall story is that net interest margin has sort of stabilized, lending activity is up, the outflow of deposits that we saw going on has stabilized as well, and I think most importantly, the provisions for loan losses that some of the bank had put aside seem to have been too high. So the two major factors that determine how much banks put aside is basically the unemployment rate and GDP growth. And both those figures have been very, very strong. So I think these banks are saying, well, last quarter we put a bit too much money away because we were too pessimistic about where the US economy is going.
I just want to get a very quick response to this. We have this story that UBS may face a higher hit on capital requirements. One of the politicians is talking about 25 billion, 15, 25 billion in additional capital. How onerous would that be to the Amoti-Callagher message, which is dividends and buybacks are back? How onerous would that kind of a additional capital requirement be to that systemically important bank?
Well, I know the Swiss finance minister came out with this announcement now saying something between 15 and 25 billion. Of course, if they have to raise that much more money, then basically dividends and buybacks are out the door. They basically have to go to the markets and try and raise that money. But I'm not quite sure how they've come to that conclusion just yet. I mean, most recently, the UBS balance sheet looked very, very strong. They seem to have very good capital reserves, seem to be doing fine. So I'm not sure where this number has come from. We'll have to look at some of the more details there. But this sounds like a very strange way to announce this, too, that it comes through the finance minister saying that UBS is going to need this kind of capital injection. Usually that's not the channel that comes from, but we'll see what they have come up with and why they're making that argument.
Indeed. Well, it is a hot political issue on Bahnhofstrasse in terms of the size of UBS. Now, Ottavio, thank you so much for being with us this morning. Ottavio Marenzi of Optimus on the banks. We're counting down to those numbers. We'll bring them to you throughout the day on Bloomberg.
top names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on their phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
DOJ or other authorities
could face bigger challenges next.
Was going to keep Rain World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Bloomberg Brief. I'm Manish Kraney alongside Danny Berger in New York. Now, as equities asphyxiate, yields spike, where do you hide? Citi would say that that is...
Gold.
Ding, ding, ding. $3,000 is the call from Citi, and that is in the next 18 months. I mean, that's a whopper. What you just said yesterday, we made another record high in yesterday's trade. So we've come back a little bit, and you can hardly call that a drawdown. 0.5%.
I mean, Citi for sure has one of the highest price targets, but it's not crazy. Goldman saying it's 2,700, calling it an unshakable bull market. UBS says 2,500. And there's buying across the board, whether it's managed money players, consumers in China have been buying massively, and central banks have also been buying a lot. China, India, all of them are gorging on gold.
Gorging on gold. There you go.
I know you like that alliteration.
Yeah, I actually do quite like that alliteration. I mean, whether it's the Fed cutting cycle is delayed, whether it's a potential recession, is an inflation hedge. I mean, there's a whole myriad of reasons, but they're coming in for that. But there is one alpha in this market, and it is the dollar. Yeah. This is an example of where you go to in times of great distress. The dollar is mighty at the moment. And perhaps HSBC have a big note out, Danny, on what you want to do. Aussie and the Kiwi look dire on the Fed and geopolitical risk.
I mean, the dollar's just clobbering its way through everything, stronger against all G10. We're going to discuss just that with Sonia Martin of DZ Bank. Up next, the context that matters on Bloomberg.
Operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
Welcome back to Bloomberg Brief. I'm Manus Cranny in New York.
And I'm Danny Berger. Here's what you need to know.
Markets remain on edge. Wall Street's plunged yesterday while the dollar continues its dominance.
It's a mixed bag of China data, and it adds to the broad risk aversion in markets.
Plus, Morgan Stanley and Bank of America wrap up the earnings parade today of the big banks.
So we get more banks. In the meantime, Manus, we have to contend with UBS saying that the next move might be a hike.
6.5%. Could you imagine if they raise rates to 6.5%? They say it would take equities down by 10 to 15%. I think that's generous.
And I think the market can barely imagine that. We're starting to, though. It's in the conversation, and it is impacting markets. It is the higher rates, the geopolitical risk. All of that is adding to a much stronger dollar. Let me show you what it's doing this morning, Manus, because it is just bulldozing over all of the emerging markets. We've had Indonesia feel the need to respond. You've had the officials over at the Bank of Korea needing to respond. You had China, which had a weaker fixing, which certainly didn't help things. And you have the yen at its lowest since 1990. It's stabilizing this morning, but you still have a dollar that's up 0.2%. Yields continue to march higher. We're not 6.5% like UBS is talking about, but we are at 4.6%, the highest level since November. It was a stronger consumer, the hedonism of the consumer that continues to spend, with retail sales yesterday much stronger, that really sent yields on another path higher. 43 basis points we've moved up over the past month. Brent crude takes a breather. We're back below $90 a barrel, down by about 1/3%. As Octavio Morenzi put it, he expects Israel to have a measured response, which is maybe why this market has been more calm, because that is the wide expectation for most investors.
And this equity market, which took a bruising yesterday, finally the stock market reacted to what was going on in the bond market, up 14 basis points on the 10s at one juncture, ending up 8 basis points. So finally, the equity market down 1.7% on the NASDAQ, down 1.2% on the S&P 500. We're trying to find some kind of stability this morning. But you're right, it is that toxic combination between houses like UBS flying a kite of 6.5%. Rates may need to go to 6.5% for stockflation. In other words, inflation that will not yield at the 2.5% level. Equities in Europe, what you've got is Europe and Australasia all playing that catch-up game to the demolition that took place in the US equity market yesterday. Commodities and basic resources are under pressure in Europe this morning. The real concern there is about, there you go, down 2.63% is the China data. Yes, it was good, pumping on all cylinders in January and February, and the growth rate will be above 5%. But it is what happened to the dissipation of the retail sales and a number of the other components in March. And that is where we're seeing a bit of a pressure on the commodity side.
Manus, I do think I have to eat my own hat, because last week I said this feels just like 2022 in that the trade, it's commodities and it's tech. But it's remarkable to see finally, Manus, finally yields go higher and there's some sort of impact to big tech. Finally, NVIDIA falls.
You've got a kind of relish in your voice that finally there's like, a bit of bloodletting in the equity market because yields popped.
Well, I mean, the resilience of equities had been remarkable, and sure, maybe earnings are going to be great and justify it all, but in the meantime, How can there not be any movement? We finally got it yesterday with what, 1.7% sell-off in the NASDAQ?
You can almost smell the 2% retracement that we haven't had for quite some time.
Yes.
Okay, let's just reset in terms of, I mentioned China when I was doing the equity market check, where the economy grew faster than expected with some signs of challenges ahead. Jill DeCease joins us from Hong Kong to break this down in more detail. So Jill, January, February, good, March, less resplendent. Good and bad news. Differentiate for me.
Yes, Manus, that's pretty much the story here. I mean, we had that headline quarterly GDP figure up 5.3% year on year for the first quarter, but then obviously those March numbers didn't really look that great. I mean, those retail sales growth figures in particular really missing expectations there, guys. I mean, that was a pretty big oof today, along with weaker than expected industrial output figures as well, which I think is pretty concerning just because, you know, we had been following sort of this two-track economic recovery story in China, where factory production has actually been pretty strong through the first part of the year, while it's consumption that obviously remains weak. I think that what that's ultimately telling us is that there's still some pretty big concerns about the economy right now. Maybe that overall GDP figure for the first quarter of the year was strong enough to keep us on track for this about 5% growth target that Beijing has set for the entire year, but there may be more that Beijing ultimately needs to do in some fashion to support the economy to make sure that it can regain some momentum as we get into the rest of the year.
Jill, often the silver lining for poor data is at least this will get some sort of policy response and help support things. Can the same be said this time around?
Well, Danny, I think this is where it gets a little bit tricky, right? Because again, that economic growth, that GDP number for the first quarter of the year was strong enough. I think the concern among economists, analysts here is that enough to say, you know, maybe the central bank, maybe policymakers in Beijing are just going to be complacent for now. I think that's really kind of the worry. Ultimately, though, I think the other concern that they have is that the central bank, in particular, on the monetary policy side, is really just pretty constrained in what they can ultimately do. I mean, especially with this idea of we don't know exactly when the Fed is going to start cutting rates, given how resilient the U.S. economy has been. There's concern about that widening disparity between what economic or what monetary policy in China looks like versus what it looks like in the U.S. I mean, China continuing to cut rates, especially if the Fed isn't going to start cutting rates until well after June or so, I think creates a gap that they might be too uncomfortable with to follow through on.
Well, one release valve is the currency, and to a certain extent, I like what Westpac said, the PBOC is bound to reality of a stronger dollar, but what did the PBOC do in the fixing?
Yeah, I mean, I think that at that point, it's really that quote that captures it. It's the reality that, so they were, the fixing was weaker than expected, so they let it tip up to a bit above 7.1 to the dollar. So ultimately, yes, a lot of analysts are saying, look, the dollar is really strong. There's a lot of onshore demand for the dollar, and so the PBOC is ultimately just going to have to acknowledge that the yuan is going to be a bit weaker. But what it ultimately wants to do here is it wants to manage, sort of that weakness a bit, sort of let it, sort of let it go lower, but make sure that it's sort of carefully managing that a little bit more. So that's why you may be seeing that weaker than expected fixing today.
All right, Jill, thank you very much for that. Jill DeCease in Hong Kong. Joining us now is Sonia Martin, Head of FX and Monetary Policy at DZ Bank. Sonia, great to see you this morning. Look, while Chinese policymakers might have said a weaker fix, the rest of emerging market FX is in the grips of a much stronger dollar. If you look at the scores on the board this morning, EMFX at a 2-year low. South Korea is jawboning after the won fell to a 2-year weakness versus the dollar. The Bank of Indonesia had to step up its support. We're now talking about 160 on dollar yen. Are we about to enter a period of mass intervention versus the dollar?
Well, yes, obviously the dollar has been very strong, and this has happened, I think, mainly actually on the back of the higher than expected CPI data from the US. I think it's actually not that much of a geopolitical move because that doesn't quite fit with the movements we've seen elsewhere. So I think it's mainly the US higher rates going to be higher for longer story that's driving the dollar higher. And yes, that is giving some measure of concern to other countries. I mean, you've mentioned Indonesia, but of course we're also looking at the BOJ and the Ministry of Finance of Japan, who are undoubtedly very worried about the the recent decline of the yen and aren't going to be happy with what they're seeing. Having said all of that, and while we might see some intervention here, I think the big question is, can this dollar strength last? I mean, I would just remind people that, over the last year, we have flip-flopped between investors being very, very bullish on the dollar, just to then turn around and become quite negative. I mean, we had a conversation, I think, last year about is the end of the dollar era near. I mean, let's not forget that happened too. And I'm not sure if we should read too much into what we're seeing right now in the market reaction to the, let's face it, only slightly higher than expected CPI reading, for the time being.
But the rates market has asphyxiated. It's convulsed. And yesterday was another prime example of that on the back of those hot retail sales. The dollar is being driven by geopolitics, undoubtedly, over the very, very near term. But rates are a real pillar of that. When you begin to see houses like UBS talking about 6.5%, Torsten Slok at Apollo, no rate cuts, and reaffirming that yesterday. It's amazing how divergent we are in terms of where we will go. You still believe that they will be able to do rate cuts? Why?
Well, again, let's look back just a few weeks, a couple of months when people were talking about the Fed cutting by 175 basis points, and everyone was really convinced that was inevitable, and we have come back from that. So what it really comes down to is the inflation development. And yes, the CPI was higher than expected, only marginally, but yes, disappointing nevertheless. But the key figure to look for is not the CPI, but the PCE, because that's what the Fed is looking at. And the next PCE data is coming out at the end of April, and I think that's going to be crucial for the Fed. If there is evidence with the PCE that inflation pressures are going to be more persistent, then yes, I would agree that the likelihood that the Fed will start cutting in June, which is our current call, will decrease significantly, and they'll have to push back. I totally agree with that. Chances that they're not going to cut at all, well, that would take a much more persistent inflation picture and potentially a pickup in inflation, maybe as a result of rising energy prices, geopolitics, etc. But it's a very difficult time for the Fed, who are probably watching the data like a hawk and are going to probably decide sort of very much from meeting to meeting what they're going to do depending on circumstances.
And Sonia, this push and pull, as you say, it's what's moving the dollar, not geopolitics. You write that investors don't even want to imagine the fallout that would result from a further escalation, and that's why markets have been trading on a benign, quote-unquote, good outcome. If the dollar strength we're seeing at the moment doesn't even take into account geopolitics, should there be real escalation that the market has to grapple with, what happens to the dollar?
Well, I think we would see a much stronger dollar in that scenario, driven for one by safe haven flows, but also, of course, by expectations that in that scenario, the Fed would definitely not be able to cut rates anymore because we'd get, a push in inflation through energy prices, etc. So that would, be a double whammy. If you then add a potential election win for Donald Trump into the equation, and you end up, I think, with a much stronger dollar, at least for quite a while. It's much more difficult when you look at the rate picture, because in terms of interest rates, I mean, yes, high inflation, less cuts would mean that US yields should remain higher, but then you'd have the safe haven argument that would stand against that. So it's more ambivalent when you look at the rates in that scenario, but definitely for the dollar, I think it would result in a significant strengthening. And then we would definitely be looking at euro dollar towards parity.
Well, let's see where those next shoes drop on the geopolitical front. I'm looking at dollar yen, 154.51. Every time you turn around, there's a new red line in the sand for the Bank of Japan and the Ministry of Finance. You say they are undoubtedly prepared for intervention, but it will be taking a risk going against the trend. And timing is everything. If you're going to jawbone a currency, which is what they've done, but they haven't put their money where their mouth is. I mean, I'm seeing in my inbox, 160 is the new red line. So what is it that triggers the MOF to actually intervene in the face of a pretty virulent US dollar?
The BOJ and the MOF are going to be really, really careful not to be seen to draw that particular line in the sand, because it always comes back to haunt them, because then people think that this is where the line is going to be drawn, and next time we're there, everyone is going to expect them to intervene, right? There isn't a particular level. I think it's about the dynamics of the move. Disorderly markets is the term that they often use. I think that's going to be the focus. And the only thing the BOJ and the MOF currently have going for them is the fact that this move is looking increasingly speculative, and you have seen speculative long positions in dollar yen rise massively. So that's something that's going to work in their favor if they intervene, because they're going to catch a lot of people on the wrong foot.
So then you might see some sort of short covering should they actually intervene. Sonia, just to end things here, in this environment where we're talking about maybe the Fed can't cut, maybe the next move is a hike, euro dollar you say goes to parity if there is an expansion of the conflict, but could euro dollar go to parity if we're in an environment where the ECB, as they've committed to, is going to be cutting quicker and more severely than the Fed?
That depends on the difference, to be honest. I mean, if it's just a question of the ECB moving in the summer and the Fed moving in September, I think that's not going to be the major mover because that's already priced in. I think you'd have to, if you're looking for euro dollar parity, at the very least, you would need to have no cuts from the Fed and cutting from the ECB's 50, 75 basis points. I think you probably need that divergence because that's not priced into the market yet. If we're going to reach parity.
Okay, two very different scenarios for parity. Sonia, thank you so much. Sonia Martin of DZ Bank. Coming up on the show, luxury is the focus. LVMH proposed to report its sales results. We'll discuss.
Studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West, only on Bloomberg Television. Context changes everything.
Season 2 of The Circuit. We're walking with the titans of banking.
Hello! You guys love these meet and greet things.
Me too! And driving a warship through the Pacific.
You're not the typical Silicon Valley founder wearing a black turtleneck. Like, how does that play?
I am a little bit of a caricature.
Taking you around the world.
So we're kind of in the middle of nowhere. It's incredible that this is the site of the biggest Netflix production ever in Latin America.
And getting you closer to tech and business leaders like never before.
You have our money, you've got world leaders on speed dial. That's a lot of power.
Sometimes I think I'm just riding the Bronco and hanging out for dear life.
You driving a Hummer is pretty badass.
That's what I'm going for, like badass soccer mom.
I'm Emily Chang, your ticket to the front lines of tech, innovation, culture, and host of The Circuit. Wednesdays on Bloomberg Originals and Bloomberg TV.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
It's Bloomberg Brief with me, Manus Granny, and Danny Berger alongside me. Over to Europe now. LVMH is set to show a muted start to the year in the first quarter results when they hit the tape. Let's bring in our Bloomberg opinion columnist, Andrea Felstead. So, the rich, have they stopped shopping, and the aspirational are reluctant? Contextualize LVMH for me. Andrea, good morning.
Morning. Yes, you're right. This is going to be a muted quarter. When you compare with it a year ago, we had China just reopening. Chinese shoppers were out revenge spending. The US hadn't slowed to the extent it did later in the year. So if you look at the numbers, the consensus is around 3% organic sales growth for both fashion and leather goods and the overall group. Both of those in the first quarter of 2023 were in the high teens, and they came in roughly twice what analysts had expected.
I guess then, Andrea, if we see results that don't show up to expectations, is it normalization or is it a large-scale slowdown?
So far, it's been normalization, and the industry is up against very tough comparatives from a year ago. Investors are expecting things to improve as the year goes on, so the comparisons get easier. They're also looking for a turnaround in the US, but we're yet to see those. We've also got an election in the US. What's that going to do to confidence? The good news is luxury tends to be correlated with stock markets, with crypto. Both of those have been pretty strong, but we haven't yet seen that crucial turnaround in the US.
I mean, it's a battle for supremacy, isn't it? I mean, do you think things will improve for Louis Vuitton later on? We're looking at a cracking story this morning on the Bloomberg. Hermès to surpass Vuitton's biggest brand. That's according to Citi. But I mean, when you look at these two brands, they are different in some ways in terms of the product range. But is that a battle that Louis Vuitton wants to sort of take on against Hermès? They do it on a daily basis, but do you think Hermès can trump LVMH?
I think they're slightly different. One thing that we've seen over the last year, it's all about selling to the 1%. If you can sell to the super wealthy, Hermès, Brunello, Cucinelli, you're doing better than if you are selling to the aspirational luxury consumer, which has retrenched. Now, Louis Vuitton's got a bit of both. It's got very high price products, but it's also got a lot of lower price bags. So it's got a bit of both, really.
Andrea, thank you so much. Looking forward to those earnings later today. Andrea Felstead, we'll see whether crypto plumbing new recent highs helps everyone afford that Hermès bag. Okay, Manus, a quick check on your bonds. I guess if you're investing in the bond market, maybe another story. Yields are at the highest since November for your 10-year. We're over 4.6%. It gained 8 basis points yesterday. UBS puts it really well, Manus, that the next move might not be a cut, it might be a hike if things stay as is, where inflation is stubborn.
I mean, I was reading through that piece, and it's almost like stuckflation. So they're worried about inflation being turgid around 2.5, 2.75.
It's the no landing.
It is the no landing situation, but it's no landing with an even more toxic scenario, which is rate hike 6.5%. Do you think equities would tank by more than 10 to 15%? Because that's what that note says.
Probably not. Probably equities will be fine, Manus. Probably equities will be unfazed. Everyone will be buying NVIDIA.
She won't be happy. She really, really, really won't be happy. Everybody be long NVIDIA. Buy that dip. You can just imagine your inbox filling up with the notes.
Oh yeah, absolutely. But the rest of the bond market follows along with the U.S. Yields moving both in the U.K. and Germany was what, 10 basis points higher?
Yeah, it's pretty
in the
mighty
UK yesterday. Yeah, and so we see that follow on today. But of course, that divergence, it needs to get pretty big, says Sonia Martin, if we're going to see something like euro parity.
Okay, coming up, Live Nation falling as the DOJ brings down the hammer on Ticketmaster.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
India's elections kick off with a focus on the economy, social divisions, and climate change actions that will influence the global story. Bloomberg is live on location with the latest updates from the world's largest democracy. Coverage begins April 19th.
Donald Trump's first criminal trial has officially started, with the judge ruling that the jurors will be allowed to hear evidence about the former president's alleged affair with the ex-Playboy model. Bloomberg's Kelly Lyons reports from outside the Manhattan courthouse.
It was a historic moment as the first ever criminal trial of a former U.S. president got underway here in Lower Manhattan. Donald Trump has been charged with 34 felony counts of falsifying business records in relation to hush money payments made to porn star Stormy Daniels in the days ahead of the 2016 election. Trump has pleaded not guilty and denies the charges, and in the hallways of the courtroom on Monday suggested that he views this as political persecution, election interference, something designed to keep him off the campaign trail. It will indeed keep him off the campaign trail, as he is required to be here in person in court for each day of this trial, which could last between 6 to 8 weeks or even longer. They had a number of procedural motions they had to work through when this trial began, including a motion to recuse on the part of the judge, which he denied, and a motion, several motions related to what could or could not be submitted into evidence. Once they got through all of that, that is when jury selection began, and it's going to be very hard work. More than 96% potential jurors were brought into the courtroom, and more than half of them said that they could not be unbiased or impartial in judging this case because of the familiarity of Donald Trump, not just as a former president, but of course the current presumptive Republican nominee. So jury selection will have to continue. It's a process that could potentially take several weeks. Proceedings will begin again Tuesday morning at 9:30 a.m. Eastern Time. And of course, this could have much consequence for the 2016 election. Bloomberg and Morning Consult have done a poll of the 7 key swing states likely to decide the election back in January that found more than half of voters in those states said they would not vote for Donald Trump if he were to be convicted of a crime. In Lower Manhattan, I'm Kaylee Lyons, Bloomberg News.
All right, let's get you set up for your trading day now. A look at what's ahead. Morgan Stanley and Bank of America, they're going to be reporting results before the bell. Then we're going to get numbers for U.S. housing starts. Those will come out at 8:30 a.m. Eastern. Then Fed Chair Powell will be delivering remarks at 1:15 p.m. Eastern. So, Manus, let's see if that makes a difference to yields. Already above 4.6%.
Yep, we'll keep an eye on that yield to equity relationship. Some micro movers for you. The Justice Department may file an antitrust complaint as soon as next month, aimed at forcing Live Nation to spin off the ticketing business. The stock down 6.75%. The CEO of Stellantis is getting pushback for his $39 million pay package. The car maker pursues deep job cuts. Those savings are there. And Coinbase down 0.6%. Will I make it back to the seat before we go? No.
Probably not. In the meantime, Manus, the market continues to move. It is a stronger dollar. It is yields higher, reaction to a stronger economy.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you also have to, you can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, you know, when you kind of look at it. And probably what's more striking is the fact that the demand for it is going up every year.
Things like solar or wind, it's nice and environmentally friendly, but really is not going to produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, solar and wind are critical components. You need, this is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. What we do at Breakthrough, we look at technologies that could produce half a gigaton, remove half a gigaton of carbon a year. And the way to think about that number is that we have to remove, say, 100 half a gigatons, you know, a year in terms of what we have to replace.
I look at 10-year yield, the market is trying to gauge where this is going to shake out.
For bonds, it's still very much an inflation story.
The level of yields in the U.S. looks pretty attractive.
Given positioning on where we have been in yields, I think we can go higher.
Now that we've seen this back up higher in yields, we are having the conversations of let's get ready to buy.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance. Your equity market right now on the S&P 500, negative 0.1%. Coming into today, two-day losing streak on the S&P 500. Biggest two-day loss going back to March of last year. That was a month full of banking stress. Right now, a month full of better than expected economic data, including US retail sales. That data coming in hot, and yields looking like this. Your 2-year, 10-year, at the moment, the numbers as follows. 495 on a 2-year. On a 10-year, 464.88. On the month so far, which bear in mind is a little more than 2 weeks, we're up by more than 30 basis points on a 2-year, up by more than 40 basis points on a 10-year. And the sell side all saying the same thing. Morgan Stanley, rates matter again for equities. Lisa SocGen, expensive valuations sitting comfortably with higher bond yields.
Because it's coming for the wrong reason. Part of it is the right reason, and part of it is the wrong reason. Yesterday, we saw retail sales come in better than expected, which caused the likes of Citigroup to increase their GDP forecast for the year. Positive, possibly, for equities. But you look to the other side, it's also stemming from increasing inflation expectations over the long term, which creates some issues of how high these rates have to stay for how long.
And we've heard the same thing from Fed official after Fed official, which is the following. 1, patience. 2, no urgency. And monetary policy is tight. Let's throw in that. 3, John Williams, New York Fed president, sitting down with Bloomberg's Mike McKee. Monetary policy is in a good place. Monetary policy is tight, immediately after a hotter than expected retail sales print.
Which raises the question, can they get ahead of this? Are they actually going to have the freedom to cut rates? To me, it seems like the market has moved on from Fed speak. It seems like unless Jay Powell says something today at 1:15 p.m. that really reiterates a time frame for those rate cuts, the market is looking at the data and increasingly pushing out potential rate cuts. Now fewer than 2 being priced into the market at a time where you've got hot inflation, but you also have this sense you're having commodity pressures that are going to make life really difficult for central bankers.
Tons of Fed speak again this week, including Chairman Powell. Later on this morning, earnings from Bank of America. In fact, they come this hour, 7:30 Eastern time. We're looking for numbers from Morgan Stanley. A lot to work through this morning. You've got to talk about the hot data, the Fed reaction, the Fed response to it. We've got to talk about China. Data in March, just a little softer than expected. And we need to talk about the response potentially coming from Israel. This, Anne-Marie, from the Israelis, there will be a response.
Yep, now everyone is focused on what the timing of that response will be, Jonathan. Of course, what Israel potentially will hit. What I like to look at is actual tangible things that are happening in the region, not just what people are saying. And what we've heard from the IAEA is that their inspectors are no longer allowed to continue inspecting some nuclear facilities. Why? Because the Iranian authorities say they are keeping them shut because of security considerations. So potentially Tehran thinks this could be a target that Israel would want to hit.
And this from Axios just moments ago, Lisa. Treasury Secretary Janet Yellen preparing fresh sanctions for Iran, vowing the following: the United States will not hesitate to inflict economic punishment in response to the Islamic Republic's unprecedented attack on Israel.
Yeah, well, what's the willingness to actually absorb the consequences of that in terms of higher oil prices? And this has been the perennial challenge. How much do you want to enforce sanctions that are going to cause oil prices to spike right ahead of the election? And this is the toggle a lot of people are playing with.
Crude prices a little softer this morning. Let's go through the price action for you. Starting with WTI, we're down about 1/3 to $85.10. On Brent crude, we're down about 1/3 to $89.83. For the equity market, pulling back just a little bit on the S&P 500. Some negative follow-through from yesterday's session in the United States in the afternoon to the European session through this morning and into their midday. We're looking at equities down in Europe on the FTSE by 1.5%, on the Euro Stoxx 50 by more than 1%. Yields up again by 4 basis points, call it 5, 464.88 on the US 10-year. Coming up this hour, we'll catch up with Russ Kostrick of BlackRock on the global stock market sell-off, Jeanette Lowe of Strategas as Israel vows to respond to Iran, and Chris Marinak of Jenny Montgomery Scott with Bank of America and Morgan Stanley earnings on deck. We begin with our top story, equities selling off with bond yields near year-to-date highs. Russ Kostrick of BlackRock saying this: we remain overweight equities, though less so than a month ago. We still believe that a strong economy will drive double-digit earnings growth, which should allow for additional gains through year-end. Russ, I'm pleased to say, joins us now for more. So Russ, still overweight. So let's start there. You've got to explain to us why the bullish thesis is still intact.
Well, good morning, Jonathan. You know, I think Lisa described it well a few moments ago, which is that you had this backup in rates, which has clearly dislocated the equity market, at least in the short term. But that backup contains both good and bad. The bad is obviously the sticky inflation. The good is an economy that is much, much stronger than anyone expected 3 or 6 months ago. And again, if you go back, let's say to last summer, and you look at the consensus of Bloomberg economic forecasts, economists were expecting maybe U.S. economy would grow about 0.5% in 2024. And obviously that reflected a lot of economists that still expected some recession probability. You go today, you look at those same numbers, growth is expected to be 2 to 2.5%. You layer on, let's call it maybe 2.5% inflation on top of that, you get to an environment where nominal growth for 24 is probably going to be in the ballpark of 5%. If you get that, you're going to get decent earnings growth, probably even better than is discounted right now in S&P estimates. And that's something that's a very different dynamic than last year. Remember, last year was all about multiple expansion, people paying more for a dollar of earnings. This year, we do think the equity market can go higher, but it's not likely to go higher on higher valuations. It's likely to go higher on better earnings.
Which raises a question of what's going to lead it there, especially because the higher valuations has really benefited the big tech complex that took it on the chin yesterday and seemed to be struggling in this new multifaceted world. So what's the leadership?
Well, you know, again, I think yesterday, at least you're totally right. Tech did struggle, but you've had other days where tech actually has held up remarkably well when you consider the backup in rates. Now, again, I think we have to be a little bit more specific here. Early growth tech companies have definitely struggled along with small caps. Why is that? They are sensitive to this backup in yields. But you think about many of those mega cap tech companies that are generating extraordinary amounts of cash flow, they're still actually doing very well. And we still would expect for this quarter in particular for many of those companies to lead on earnings growth.
One thing I'm thinking about a lot today is there are a lot of comparisons to March of last year, whether it's the biggest sell-off in the S&P, as John mentioned, whether it's the biggest spike in the VIX that we've seen over the past 2 days. How close are we to another moment like that with higher yields based on the fact that small banks still haven't dealt with the problems? They still are much more vulnerable to higher rates for a longer period of time, especially without some of the deposit stability that a lot of people have been looking for.
Well, I definitely agree that the regional banks, some of the smaller banks are vulnerable. We've actually been underweight that sector for some time. And then the other part of that, which we haven't gotten to, is commercial real estate. So that's part of the economy that I'd be concerned about, not in the sense that we're looking at a systematic crisis, but just that these banks do have a lot of fundamental challenges. But again, you go back and you compare the economy today to a year ago. A year ago, the concern was after Silicon Valley Bank, after First Republic, after Credit Suisse, we were looking at another systemic banking crisis. I don't think that's the problem today. Today, if anything, we have the opposite problem that, aside from some issues in some of the smaller banks, the economy is very robust. We saw that again yesterday with retail sales. And if anything, rather than people adding Fed cuts, which was the case a year ago, now they're taking them back.
Russ, there's a reason, though, as you know, why some people are still calling this survive until 25 in certain parts of fixed income, because they want rates to come down by 2025, and they need to survive until then. It's very self-explanatory. Right. So, Russ, I'm trying to work out whether credit is starting to confirm some of those concerns. Now, spreads have been very, very tight. They've just started to widen over the last week or so. How would you frame the moves developing in credit?
So credit has been interesting. As you say, spreads are tight, and what we've really been doing in the portfolio is maintaining the credit and the spread exposure we have. And that has been a very nice tailwind. It's allowed us to carry above the benchmark. But again, I think you have to go back to the strength in the economy. It's not that there will not be pockets of stress, particularly as rates rise. But if you have an economy where growth is solid, and let's remember, many of these companies, including those in high yield, refinance their term, the distribution of when their maturities come due. They refinance that back in 21, 22. So you're actually looking at an environment where we think the default rate for most of those companies is going to stay low. It's actually today fairly well below the long-term average. And if you have that position in your portfolio, you can carry above benchmark. You don't necessarily have to be in a rush to sell it. Although I agree, at this point with spreads where they are, you may not be adding much either.
Russ, you've said it a few times in the last 5 minutes, the strength of the economy. I think we need to be more specific than that. The strength of the US economy. Can we talk about the rest of the world? Can you tell me how that factors into some of the things you're telling us this morning?
So I do think the US is leading. And this is one reason we remain overweight U.S. stocks. We still have a little bit of an overweight of the dollar versus the euro. And this does respect this growth and this differential in growth that we see. Europe clearly struggling a bit more. Japan is actually doing okay. China, we had some positive news this morning. But I do agree that this is a global economy, as we've seen many times in the past 20 years, that is primarily being led by U.S. strength. And again, a lot of that strength is based in the U.S. consumer, where you've got a strong labor market, you've got decent household balance sheets, and you've got a consumer that clearly is still willing to spend.
Russ, let's fold that into the policy conversation. We've been discussing it over the last week, the limits of central bank divergence. Russ, what do you think they are?
In terms of the divergence between the U.S. and other central banks?
The ECB, the BOJ. Look at the euro this morning, 106. Dollar yen pushing through 154. Yeah. I think we're just trying to work out how much further the ECB could go without the Federal Reserve joining them in a rate-cutting cycle.
Well, I think the ECB is probably going to have more latitude to cut than the Fed. And the reason for that is obviously you've got a weaker economy in Europe. The U.S., we do have some persistence in inflation, particularly around services, which you're not seeing in every other part of the world. So one of the reasons the dollar's been so resilient is because you do have that policy divergence. And there's another aspect to that as well, which is interesting. Again, we've spoken about this in other broadcasts. Up until 2021, when you think about building a portfolio, what is your hedge against equity risks? For 2 decades, it was generally bonds. Clearly not the case in an environment where macro volatility has been higher, inflation volatility has been higher. What has worked very well on these days when equity markets have sold off is generally been having a long dollar, overweight dollar position. Because if you're worried about the Fed, when the market is selling off, generally you're seeing better dollar strength.
Just to put a bow on that, to me it seemed like when I walked in, there are 2 haven trades now that work. Gold and the dollar, that's it. Bonds don't work that way. Is that kind of how you're playing it?
I totally agree on the dollar. The gold has empirically worked that way. I have to be honest, I have a much harder time explaining the move in gold. Clearly, there's some central bank buying that's supporting that. But when you look at what's happened with the dollar, if you look at what's happened with real or inflation-adjusted interest rates, it's very hard to explain why gold's doing what it's doing. One explanation might be that obviously we're in an environment of heightened geopolitical risk, and many investors might be leaning on gold as they have in the past. Is that geopolitical safe haven?
Hey, Russ, great to catch up, buddy. As always, Russ Kostrick there of BlackRock. Still bullish, still overweight, this equity market. Speaking of gold, do you see the call from Citi?
3,000.
3K.
Crazy.
Bullish call from Goldman, too, in the last week as well.
Coming from the idea that people are going to pile in. They're going to ride that train that the central bank started. And honestly, this is what we've heard pretty much across the board. Raising this question, again, is this the new haven? You got gold in one pocket. You got the triple leverage gold fund, the triple leverage dollar fund. You know, kick bonds to the curve.
It's EK if you're watching.
That was for you.
Lisa trying to inspire some new products for 2024. Gold just a little bit softer this morning with negative 0.4%. Let's get you an update on stories elsewhere. Let's get to your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Well, you stole my thunder. I was going to start with gold, but instead, let's get to the geopolitics. Axios is reporting that the U.S. Treasury is preparing fresh sanctions for Iran following its weekend attack on Israel. The Treasury vowing that the U.S., quote, will not hesitate to inflict economic punishment on Iran. The move comes as President Biden urges Israeli Prime Minister Benjamin Netanyahu to be strategic and show restraint when it comes to possible military action. Xi Jinping is pushing back against European and U.S. pressure to rein in China's powerhouse industries. The Chinese leader told German Chancellor Olaf Scholz that a surge in Chinese clean tech exports has helped the world tackle inflation. Xi's comments suggest China may not be swayed in any meaningful way by Western leaders who want the country to reduce its excess manufacturing capacity. Shares of Tesla falling in the pre-market. Two of the company's top executives have announced that they're leaving the company amid the car maker's largest ever round of job cuts. Tesla is cutting 10% of its workforce to slash costs as EV demand slows. Sources tell Bloomberg that the cuts could reach closer to 20% in some divisions. Already so far this year, Tesla shares are down more than 30%. That's your brief, John.
Hey, Danny, thank you. A difficult moment for that industry, that's for sure. Up next on the program, Israel vowing to respond.
Israel proved it has superior military capability, and just as critically, they don't stand alone, that the United States stands with them. There's no question that Iran recognizes the coalition that was put together to help Israel defend itself.
That conversation up next, live from New York City this morning. Good morning.
multi-trillion-dollar industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
DOJ or other authorities
could face bigger challenges next.
It was going to keep Green World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley.
Live from New York, welcome to the program. Equities a little bit softer this morning, down another 0.2%. Biggest two-day loss going back to March of last year on the S&P 500. Really weak session yesterday. Bond yields higher again by 4 basis points on a 10-year, 464.68. And crude behaving itself for now. WTI, $85 and about 10 cents. Under surveillance this morning, Israel vowing to respond.
Israel proved it has superior military capability, and just as critically, they don't stand alone, that the United States stands with them. There's no question that Iran recognizes the coalition that was put together to help Israel defend itself. Again, I can't speak for what either side will do going forward. Iran is increasingly isolated on the world stage. They are increasingly making it harder for anybody in the international community to be sympathetic to any of their inimical interests there.
Here's the latest. Israel's military chief saying Iran's unprecedented attack will be met with a response. He provided no further details. On Capitol Hill, House Speaker Mike Johnson planning to hold long-delayed votes on new aid to Israel, Ukraine and Taiwan. Jeanette Lowe of Strategas, a bed company, joined us now for more. Jeanette, let's get to the nature of the response we can expect, the options on the table. What do you think they are?
So I think Israel has a number of options. They're going to try to do something to somewhat, proportionate to say, Iran did a huge barrage of missiles and drone attack on Israelis' airspace. So they want to do something probably to counteract that. Now, they have a couple of options. Maybe they target, a drone facility in Iran to try to take out the actual munitions that were the culprit of this attack over the weekend. That way, they're not actually causing any casualties. They could do something more covert. They could do a cyber attack. They could wait to kind of bring down the temperature a little bit and then act again at some point in the future. So they do have several options. I think there's definitely pressure from the West to try to turn down any escalation in the region and try to say that they should not retaliate, but does seem like Israel's going to do something. It's just whether or not it is escalatory or not.
Jeanette, we learned yesterday that Iran is temporarily closing its nuclear facilities and they're citing security concerns. Is nuclear an option for Israel?
So they have done that in the past, right? They have targeted Iran's nuclear facilities, its nuclear capabilities, its development. So that is definitely probably something that they are concerned about and thinking about whether or not that could be an option, especially as you've had, increased uranium enrichment in Iran. I don't necessarily know if that might be on the table, but that is something that they have done in the past. It might have to be more of a cyber attack than actually doing a bomb, because that would be quite significant since most of these facilities are actually underground. But that is probably something that is still on the table.
Are we in the start then of a vicious cycle? Because once Israel responds, is it warranted then that Iran is going to respond? Is that what you would expect?
Right. So this is where this delicate balance has to come into play. So if you kind of look at what happened with the U.S. when we killed General Soleimani in Iran back during the Trump administration, Iran struck back, but it hit targeted U.S. bases, but there were no casualties, and that kind of allowed, de-escalation to then occur. What Israel's response here might be is going to be important. Again, if they try to target something like a missile depot or something like that, that's not a strong strike, maybe it's just a little bit more targeted, that allows things to calm down and not require Iran then to retaliate again. So I think there does have to be this balance to try to figure out how can they show some strength, but at the same time not escalate things further. I do think Iran does not want to actually have a major conflict. They do not want to get the U.S. involved. And so there is also that piece of it, which is also why the U.S. and other Western allies are trying to get Israel to lower the temperature and to maybe not retaliate.
Jeanette, on the domestic front, this raises a question of whether it's more likely that there is some aid passed in the near term. We know that the House is interested in taking up a bill, but possibly two separate bills for Israel and Ukraine financing. What do you think the probability is that we're going to get something or see some action on this front in the next couple of weeks?
So we actually are quite optimistic that we are going to get something done. I think Speaker Johnson has been much more supportive of getting aid to Ukraine since he's moved into the leadership position. This has been something that he's been talking about getting done once they came back from the March recess. He's now putting something on the table. This does have the opportunity. It's a tricky package that he's trying to put together because he's trying to create separate packages for Ukraine aid, for Israel aid for Taiwan, but then also putting some other pieces into this as well, kind of things like the Repo Acts, where they could seize Russian assets and use that to pay for Ukraine reconstruction. They're thinking about re-putting the TikTok bill back into this package, so that way the Senate would be forced to vote on whether that the app should be divested from ByteDance. So they're going to then package it and send it over to the Senate to try to force the Senate's hand a little bit on this and pushing it towards the end of the week. But we are optimistic that they can can get it done. It just might be a very messy process, and there might just be some, changes to what the legislation was that came out of the Senate.
In the meantime, the administration is looking to act unilaterally in the ways that they can. Axios reporting this morning that Treasury Secretary Janet Yellen is saying that she will not hesitate on new Iran sanctions actions. This raises a question: how willing is the United States to enact some sort of policy that would cause oil prices to significantly increase ahead of the election?
Right. So that's definitely a risk for the president as he goes into this re-election and we go into summer driving season. We're already seeing gas prices go higher. They're expected to obviously go higher during the summertime. So they're not looking to have an increase in gas prices over the next couple of months, as that's going to hit American pocketbooks. And that's never a good thing for the president's approval rating and then leading into the ultimate election. So I think they do need to be careful here. Obviously, sanctions have had a modest impact. And so you still have China buying Iranian oil, which is not helping to actually make them enforced. But the president does have other tools as well. He may let oil out of the SPR again this year to try to help with oil prices. But I think they're going to be targeting Iran sanctions. There's going to be bills in the House. There's going to be bills in the Senate. They're going to try to get that enacted. But I think right now the bigger pressure is probably to put more pressure on Iran, either through China or just to get them to maybe stop with the Houthis. These are the kinds of things that they're actually going to probably be more focused on rather than actually trying to stop oil from Iran.
Jeanette, you touched on it. Do we need new sanctions, or do we need to enforce existing ones?
Yeah, I mean, this is the big question. We have been putting numbers of sanctions on Iran for quite some time. And the problem is that what you're starting to see is that there are these countries who have been sanctioned by the United States, countries like Russia, Iran, North Korea, that are now trying to create these ways to skirt these sanctions. We had some talk out last week about China and the way that they might be helping Russia in its war with Ukraine by providing some dual-use pieces that go into military equipment to help them with their, offensive against Ukraine. And that's kind of doing a sanctions evasion in some form. So this is kind of the problem. We're having these other countries who are now trying to challenge the United States' sanctions regime. And this is kind of the problem that we're moving into this new era. It's much more multipolar world where you have countries like China and Russia and Iran trying to challenge the United States, trying to actually distract the United States, which a lot of different skirmishes. You've got Ukraine, you've got what's going on in Israel, what's going on with the Red Sea. And all of that is designed to start to try to divert U.S. attention, use up resources, use up the federal budget, use up munitions, and kind of create this opportunity for the U.S. to have less power and other countries to have more.
It's a massive issue. Jeanette, thank you. Jeanette Lowe there, a strategist. Let's go to the words of Admiral Kirby yesterday with us. Iran is increasingly isolated on the world stage. They are increasingly making it harder for anybody in the international community to be sympathetic. Memo, Russia, memo, China, did they get it?
It's very challenging because I would love to know what the administration defines as isolated. You have Iran exporting more than, or producing at least more than 3 million barrels a day, all that going to China, as well as sending weapons to Russia, and at the same time, fresh new diplomacy with some Arab leaders.
On sanctions, expect to hear from Secretary Yellen a little bit later on today. Coming up, Constant Hunter, Macro Policy Perspectives, looking ahead to Fed Chair Jay Powell's comments a little bit later this afternoon. From New York City, this is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal. The Deal. That deal. The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Wow.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Shaky start to the week in global markets. Yields up, stocks down. Let's check it out right now. Stocks down, yields up. Kind of a repeat of Monday, just less aggressive. Equity futures down 0.25% on the S&P 500. On the Nasdaq, we're down about 0.4. Small caps pulling back again, down by 0.9. Tech was outperforming, then it got hammered. I can't keep up. Every single industry group was in negative territory at the close yesterday. Let's turn to the bond market. 2-year, 10-year, 30-year. The 2-year at the moment about 4.95. Up another 4 or 5 basis points on a 10-year to 464.47. Lisa, at the front end of the curve so far this month, up more than 30 basis points. On a 10-year so far this month, up more than 40 basis points. It's been quite a repricing in fixed income.
And it strikes me that the reason why people said that rates and the increase in yields hadn't affected stocks more was because the pace was sort of the slow grind. Well, in the past couple of weeks, this has been something other than a slow grind. This has been a shift dramatically higher in light of the hotter than expected CPI and then all the follow-on reads that have all been hotter than expected. It's the pace, it's the increase in inflation expectations, it's the overlay of geopolitical concerns, it's the overlay of valuations that people want to sell. And this raises the question, is it actually going to be a dip, or is everyone going to buy it before we get there?
The dip so far is about 3 to 4% on the equity market off all-time highs. The data so far this month, we'll talk about it more in just a moment. I think it started with the ISM manufacturing, prices paid, really punchy. And that was it. Yields up and away, and that's where we stayed. Let's turn to foreign exchange. Push the bond market moves through FX, and these are the numbers you get. I remember, Lisa remembers, everyone around this table remembers when 152 was a problem for the BOJ. Then 153 happened. Then 154 happened. And Lisa, now we're having a conversation about not just 155, but some people talking about 160 on dollar yen. This morning, 154.54.
There was some people, JP Morgan and Bank of America, talking about 160 on the Japanese yen, because at this point, it's a policy response to something that is fundamental. Can they fight against this freight trade? Ultimately, this raises a question of how far the globe can diverge from the U.S., and you were asking this earlier. And honestly, it's compelling to me because it's such a difficult nut to crack. It's not just the dollar, it's not just their currencies, it's also oil prices. And we heard that today from the ECB, or from one of the members who said, we can cut rates, but our hand might be called by geopolitics.
And the price of crude. Mohammed Al-Erin's going to join us in about 30 minutes' time, so don't miss that conversation on U.S. exceptionalism. Under surveillance this morning, your top stories. China reporting faster than expected economic growth. The country's GDP growing 5.3% in the first quarter of the year. However, the data coming with a reported slump in retail sales and industrial output for the month of March. So, Bramo, decent quarter, weaker end to it. Is that the way you frame things?
People are worried that maybe it's losing steam. There's a sense that maybe it's not going to fuel the same kind of growth. If you dig within the numbers, there's also another takeaway, and this goes to a policy question that we've been talking about, which is that the gains came from factory output. It is the exporting of cheap goods that they want to support their economy, and it's working on the margins to the big chagrin of policymakers around the world that don't want cheap Chinese goods flooding the rest of the world. And that, to me, sets up this sort of shift of domestic property investment to factory output, which is exactly what a lot of people don't want to see.
Absolutely. When you look at the domestic demand, it's not even flat. It's really underperforming when it comes to China. And this is the problem that's holding the country back economically. You look at what Bloomberg economists say. They say the pickup was almost entirely driven by public investment, and that the private demand suggests the recovery is on thin ice. So there's this standout potential closer to getting that 5% target, but under the hood, it's looking really shaky.
This has got to be a big feature of the IMF World Bank spring meetings later on this week, hasn't it? Hasn't that got to be top of the pile?
On one hand, you have to think if you're worried about inflation, the disinflationary impulse from China has to be somewhat welcome. How can you say we want more expensive goods? On the flip side, how do you talk about unfair competition and how you understand what the new global level playing field is when it is highly confusing? This is a fraught moment. It's a great moment for us to be going to Washington, D.C.
It's a lose-lose situation, I think, for politicians, and I think it's a good excuse to go. I agree with you.
Thank you.
We'll be in the nation's capital later on this week. Special coverage for Bloomberg Surveillance Thursday and on Friday. Let's turn to this story. Top military officials in Israel saying the country will respond to Iran's first ever direct attack on the country. Allies warning a tit-for-tat response could lead to a wider war. An Israeli military spokesman telling Bloomberg the government has been presented a range of possible options. So AMH, let's talk about the potential options. What are they?
Well, we heard from Jeanette Lowe, and she's talking about something like potentially cyber. There's potentially, she's talking about this diplomatic dance Israel needs to do to show force and strength, but also not create a retaliatory cycle. One thing that Iran is doing, we know from the IAEA as of yesterday, is they said they're not reopening nuclear facilities because of security concerns. So that says to me that Tehran is incredibly worried that that could potentially be a strike target from the Israelis.
The word we used a lot on yesterday's program was contained, and I remember Lisa responded by saying, yes, sure, contained but not calm. And I think that's where we still are, contained but not calm.
We don't understand what the response is. I don't even understand who exactly is leading the charge in Israel, because there are 3 members of the war committee and they're at war with one another and they're longtime rivals. So you take this out. How does the U.S. influence 3 warring rivals to not necessarily escalate this? It's a really fraught moment, which is the reason why you see that nervousness under the hood.
If you are just waking up and tuning in, you probably want to know what the price of crude is this morning. Brent crude is just a little softer. We're negative by 0.25%, just a break of 90. Again, 89.88 on Brent, WTI 85.16. Let's turn to the Fed speak. President Mary Daly saying there's no urgency to cut interest rates. The comments coming after Williams said he still expects cuts to begin this year. Going to host the Fed speak on deck today with Jefferson, Williams, Barkin, Collins and Powell all speaking. Constance Hunter, a macro policy perspectives, joined us in New York around the table. Constance, good morning to you.
Good morning. How are you?
I'm really good, and I think we're all trying to work out where the Fed is right now, given the recent economic data. Michael McKee sat down with the Fed president of New York, John Williams, and he said monetary policy was in a good place. Monetary policy is tight. Is that how you would describe monetary policy right now, relative to the information, the data we're getting?
Yeah, I mean, they're in a good place because they have room to move. So if we see a deterioration in economic conditions, they have room to move down meaningfully. They're in a good place because the economy does appear to be chugging along. We got the retail sales yesterday. We can debate how strong they really were under the hood or not under the hood. On a real basis, year over year, they're up 0.5%, and they were negative for the first 2 months of the year. So retail sales for the quarter on a real basis are negative, yet trending slightly higher, right? So that, you could say, consumers chugging along. You know, there's cracks in the financial system here in the U.S. in the sense that we have commercial real estate as this slow burning thing. There's, you know, so there's certainly some cracks under the hood. We're concerned in some regard with how strong the labor market is, and of course, inflation is giving us a lot of mixed signals right now. So. If you dig under and you look at what percent of goods are changing price, that's a really good indicator with regard to is all of the price movement one way. So we're seeing that it's actually two-way on a month-to-month basis under the hood. That's a good sign that it'll continue to trend down, but it's being much stickier than the Fed wants. So they are in a good place. They can hold rates, but if things deteriorate, they can also cut rates and have a substantial impact.
Can they hike rates?
They could hike rates. That is not my base case. I know a lot of people have been floating that. I see you're going to have Torsten on later. He's going to be talking about that.
He's going to be talking about no cuts.
No cuts, I guess. But you know, people are floating this possibly they hike. And certainly, look, we have the risks that we have geopolitically. And as you were talking about, you know, at the bottom of the hour, right, that there's these cross currents. You have the deflation coming out of China, but you have the possible inflationary impact of higher oil prices. So, we just have to wait and see.
When we talk about central banking response to some of the geopolitics, Olli Rehn, over on the Governing Council of the European Central Bank, came out overnight and talked about how geopolitics pose the biggest risk to rate cuts for the ECB. This is fascinating and speaks to the whole idea of the divergence of the euro and what that does if oil prices are also spiking. How much do policymakers have to respond and have to consider a tighter monetary policy in response to higher commodity prices on the heels of geopolitics?
I mean, geopolitics is why Europe is in the position it's in right now, right? It was the Ukraine war that caused so many price increases in Europe, that caused supply constraints. So if you look at the underlying strength of the individual European economies, they're much, much weaker than the U.S. They don't really warrant this level of interest rates, except that the ECB had to respond to the price movements that were brought about by geopolitics.
In the UK, there's a really interesting conversation developing, and I actually think it started with Governor Carney a number of years ago. He talked about how the speed limit of the British economy had changed. And an old friend of this programme, Megan Green, I think, wrote about that in the Financial Times recently. Yeah. The UK is not the United States, that they can't run a high-growth economy because it will mean much higher inflation. What does that look like in the United States? What is the speed limit of the US economy?
Well, and John Williams talked about that a little bit yesterday, right? So if we have higher productivity, we have, for a period of time, higher immigration, and that raises potential GDP, and you're talking about it being raised from 1.5 or 1.8 to 2 to 2.2, that's meaningful. Like, you're compounding 40 basis points over several years. That is a significant change. And so, we're definitely of the view that many of these productivity gains are just getting started, that there are a lot of positive virtuous circles happening within the economy to fuel that. And if that is the case, if we end up being correct and we can have productivity gains of 2.2% reliably for the next several years, plus slightly higher population growth due to immigration, yeah, we're looking at a potential GDP that sets us up really well to have a nice, late 1990s period of growth.
I know you've been focused on that a lot. Can we just sit on productivity a while longer? What are the tailwinds for durable productivity gains in this economy?
Yeah, so there are several. One is that we're having this high level of business formation, and we thought that was a sort of COVID thing, that it would fade. It's maintained this very high level that we hadn't seen, actually the highest ever. So when the data first started being collected in 2005, we're way above those levels, right? And newer firms tend to be more productive. They adopt new technologies, and that's a really good thing within the economy. Then, of course, AI, and I mean not just ChatGPT, but all the forms of AI that are still diffusing throughout the economy. That is so significant for productivity gains, and that is really just starting to be deployed widely, right? There was just a paper out from NBER, a number of really well-known authors talking about the use and diffusion of this technology, and it's growing, and it's expected to continue to grow. And then, of course, you have tech workers being laid off, and they're diffusing now out into the economy. That diffusion brings technology know-how into other companies, which is a good thing. When I was at AIG and we were trying to hire programmers, we were trying to hire tech workers, and so 2022, you couldn't buy them at any price, right? And we're not stupid. We're like, okay, well, this is going to come back eventually. We're going to have to scale back our hiring plans. And now all these firms are able to hire these workers, and that diffuses the technology throughout the economy.
You also look a lot at capacity utilization. What are you seeing in terms of the different industries? Who's ranking the highest?
Yeah, so manufacturing is very high right now, and that makes sense, right? You've had this huge build-out in manufacturing capacity in the U.S. That's where a lot of the structures CapEx is going. That's really the CHIPS Act, right? And so again, you're seeing those new factories are also more productive, right? Because if you're building a new factory, you're going to make every aspect of it the latest technology.
Constructive on the American economy. Constant Hunter there of macro policy perspectives. Want to get you an update on stories elsewhere just briefly. Before we get to our brief, we're looking for Bank of America results. Those earnings are going to drop any moment. Before we get them, let's get you up to speed on the news elsewhere. Here is Danny Berger. Hey, Danny.
Hey, John. Another bank, another upgrade to gold. Citi's new target is $3,000 over the next 6 to 18 months, juiced this time by money managers as they play catch-up from demand we've already seen from consumers in China and central banks. The latest leg of this rally, which hit an all-time high yesterday, has been driven by haven buying. President Biden is hitting the campaign trail in his home state of Pennsylvania. Biden's campaign says that they're going to be highlighting the differences between the president's tax and economic agenda versus that of Donald Trump, who oversaw tax cuts for the wealthy and corporations. Biden's trip will include Pittsburgh area events, where Nippon Steel's takeover deal for U.S. Steel has irritated his union allies. And the best thing to happen to basketball in a long time, Caitlin Clark has gone first overall to the Indiana Fever in the WNBA draft, surprising no one. The former Iowa star became a household name during her record-breaking college career, playing a key role in driving TV ratings for the women's March Madness tournament. Can she do the same for the WNBA? She'll be faced with turning around the Indiana franchise that hasn't made the playoffs since 2016. That's your Bloomberg Brief. John.
Danny, thank you. Up next on the program, wrapping up earnings on Wall Street.
There are still big macro risks in the marketplace. I think strength and stability seems to be a bigger presence in the strategic boardroom of these banks.
Numbers from B of A just drop in. That conversation up next.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words and then you put a few sentences together, and one day, you might be able to write poetry.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis from and about politics' biggest power players.
Let me just start with, this is not the first time we've heard this argument.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Equities right now on the S&P 500, just negative, just about, negative 0.04%, recovering just a touch in the last 10 minutes. Under surveillance, wrapping up earnings on Wall Street.
There are still big macro risks in the marketplace. And I'll tell you, when I talk to bank management teams, it's almost like I feel like I'm having a credit analyst discussion more than an equity analyst discussion. They're very focused on their own balance sheet. I think strength and stability seems to be a bigger presence in the strategic boardroom of these banks.
Here's the latest. Bank of America and Morgan Stanley reporting as Wall Street's biggest banks wrap up earnings. Goldman raising the bar in the last 24 hours, posting a surprise 28% jump in profits. Bank of America dropping right now. Bloomberg's Sonali Basak joins us around the table. Sonali, Brian Moynihan saying it was a strong quarter. How strong?
Strong enough. You had them beat on net interest income. Remember, this is very good news after we did not see the same over at JP Morgan and at Citigroup. Of course, Bank of America, with its big lending presence relative to trading investment banking, exactly what you'd want to see. They actually came in above where they were last quarter. Remember, there was a worry they would be trending lower. Also, when it comes to trading revenue, they were in line to missing a little bit on fixed income, but equities beat expectations. So all in all, it's really the net interest income here that has the first look over at Wall Street.
I want to get to this headline as well, the $700 million FDIC special assessment expense. Not the first time we've seen this in bank earnings over the last couple of quarters. Can you frame whether this is complete, whether this is done? How far along are we in this process?
It's still coming. And remember, you look at the efficiency ratio, that's another place that they missed analyst estimates here. They came in above where Wall Street was guiding for. It's now at 67%. And listen, with an era where they're already trying to keep a handle on costs all over the board, all of these banks have really suffered from the weight of that FDIC assessment. Even JP Morgan had guided their expenses higher in part because of that assessment. So the story's not over. Regulatory costs may remain somewhat high, but we are getting past at least that first year now since the bank failures that began last year.
I'm old enough to remember when it was sort of cost cutting and that was trying to reduce the expenses was the focus of so many of these banks. We saw JP Morgan costs coming in above expectations. Bank of America, first quarter compensation expenses, $10.2 billion versus the expectation of $9.99 billion. What do you make of that?
Direction of travel is higher. Listen, we've been talking about it with Goldman, where if you're making more money, you also have to pay people more. That's the problem behind it, isn't it? And so, you know, on balance, again, that efficiency ratio being higher, it's that flurry of ideas here, the compensation being higher, the regulatory charges being higher. So keeping a handle on costs. One good news is because that net interest income came in above expectations, interest expense, Lisa, you've been pointing at it all season, that has been a big weight on that net interest income. And for them to come in a little higher is good news, at least on that expense line.
Shanali, stay close. The stock is down by about 0.1% in the pre-market. An upside surprise on trading revenue. To weigh in, Chris Marinac of Janney Montgomery Scott joins us now for more. Chris, you've had a few moments to go over this one. What's the signal you're taking away from earnings season so far?
Well, charge-offs, John, are rising, and I think the overall provision expense is mixed. We saw provision rise for B of A this morning, which is a good thing because they had a pretty healthy step up of their net charge-offs. I do think it's interesting that we're seeing deposits act very well. Deposits grew for the whole system in Q1, and they were higher for B of A this morning. You're particularly seeing that in the wealth management business for B of A. I also think that the balance sheet is seeing a little bit of expansion on the securities book, which is another way for the company to try to manage net interest margin, take advantage of higher interest rates.
Chris, this is something we've seen as a theme. We saw this with Goldman Sachs. We saw this with JP Morgan, the use of a balance sheet to really engage with fixed income currencies and commodities trading and others. How much is this a new tactic, in part, we were talking about this yesterday, to compete with the private asset managers?
Well, some of that is true, Lisa. I think the other thing that's happening is the banks simply want to try to grow net interest income this year, provide themselves latitude on PPNR, which gives them cash flow to earn through the cycle. As losses rise on whether it's commercial real estate, C&I loans, or consumer, you're going to see banks have to fund that through the provision expense. So having more income coming through the balance sheet makes a lot of sense. To me, that's the primary reason why you're going to see securities grow.
So this raises a question, are they taking more risk or just being more aggressive in terms of commercial lending?
I think it is taking more aggressiveness on managing the balance sheet in terms of cash and liquidity. I don't think they're necessarily taking more loans. Loans were positive, but I think generally speaking, we're going to see loans very slow this year across these large banks.
B of A pointed out, Chris, that for sales and trading revenue, this was the highest for Q1 in more than a decade. Chris, where is this strength coming from?
Well, fixed income for sure. I think there's a little bit of better equity activity at certain pockets of the marketplace. I think commodities continue to do well, and they're a player there. So I think it's a little bit of everything that's contributing.
Chris, could you talk to me about the kind of bank, the kind of business model that you think is the optimal way of getting exposure to banks in 2024? There has been this theory that net interest income is going to be challenged this year, that story cuts both ways. What kind of business model do you want exposure to?
Well, I think right now having a balanced attack to where you are part consumer, part commercial, you do have the investment bank that can be helpful. I do think that the wealth management business can be a buffer. So I think having all of those, that's where the large national banks really compete very effectively. By the same token, I think the spread business will be surprisingly better than expected this year to some extent because banks are still resetting loans on the upside. So higher for longer actually has a contribution to spreads rising in terms of loan yields getting better. We think the cost of funds is going to level out as the year goes on, although it's still quite high. It still is a challenge.
Chris, how are they dealing for the Basel III endgame and the fresh regulations potentially we're going to be seeing out of Washington?
So most of the banks have been building liquidity for the last 6 to 9 months, and that's the primary reason that I think Basel III has been a sort of holding back earnings. From the capital standpoint, it feels like we're going to see the change in terms of excluding the unrealized losses for the regional banks above $100 billion. That ship has already sailed. I think a lot of the other changes to risk-weighted assets may not be as bad as expected. We still haven't had a final ruling on that. The risk-weighted assets, the growth of the balance sheet and how that creates capital calculations is really where some of the nuances are. We still think there's going to be a little bit of relief there, but the main tenets are liquidity and this capital calculation for unrealized losses.
Of course, commercial real estate has been front and center given some of the issues some banks are dealing with. Brian Moynihan told Lisa and John recently when they interviewed him, it's a, quote, slow burn for the banking industry. When do you think that is going to shift? Does it all rely just on the Fed?
Well, I think it's going to shift in probably about 6 to 7 quarters. I mean, we're still in the second, third inning of this credit cycle, and while we may not be anywhere near as bad as we saw 15 years ago, thanks to leverage and more equity in deals, we still have higher losses and higher problems to deal with. So I think the slow burn attitude is correct, but I think it's going to take us deeper into 25. If interest rates come down, it's going to simply give banks flexibility to work through loans a little faster, provide better options to clients to work through as some of these loan resets happen. The maturity walls that we all talk about are real, but there's going to take several years to play through. So we have to kind of deal with what's going on the maturity wall in 24 and 25, and that's the real keen interest that we have.
Hey, Chris, thanks for jumping on with us this morning to respond to some of these numbers. Chris Marinac there of Jenny Montgomery Scott. Shanali Basak still with us around the table. Shanali, had a few extra minutes to go through this. What jumps out for you?
A few things. Even though you had Chris really talking here about this idea that net charge-offs are jumping, provisions for loan losses are lower than expected. So what you see is loans souring a little faster than analysts had expected. Interestingly, also, we have been talking so much. I think we've been really paying very close attention to that drift higher in FICO scores over in Bank of America's consumer base. It is stunning. John, consumer vehicle lending, you need a FICO score above 800 at this point. You need an
800,
average,
seriously?
800. For consumer credit cards, that's 777. It was 774 last year, the same quarter. And if you look at the new accounts, there's a little pressure on that line. So the discipline being instilled by these banks as...
Hold on a second, not to cut you off, but is it discipline or is it the luxury of being at the top? They can say, we want the top, we will give you great deals, and everybody else, oh yeah, hey, you regional banks, you guys can pick up the slack and deal with the charge-offs, as well as maybe some of the increasing problems with respect to demand.
A little bit of both. You're looking at these banks really dealing with higher income customers. You heard JP Morgan say the same thing, this idea that the lower income customers are where you're starting to see the stress. And so when you see credit selection here, you see it very clearly as they're extending debt. Now, what does that mean? Can they kind of squeeze more out of their high net worth customers? Maybe. But another point that Chris was making, the institutional businesses, they have not been getting the premium in trading that these big consumer banks have been getting in the last year. And so this idea that the Wall Street rebound can really save these banks is a bit under question when the VIX is also on the rise, isn't it?
800 is absolutely stunning. Can't get over that. Shanali, thank you. Bank of America down in the pre-market by about 1.3%. More from Shanali in the next hour. We'll get numbers from Morgan Stanley, expecting them around 7:30 Eastern Time. So about 34 minutes away. Coming up in the second hour of Bloomberg Surveillance, we'll catch up with Mohammed Al-Erin of Queen's College, Cambridge, and David Hunt of PGIM. A big conversation coming up about U.S. exceptionalism in the equity market on the S&P 500. Just about unchanged through most of this morning, following some of the losses in yesterday's session. Equities right now on the S&P negative 0.1% from New York. This is Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
A cruise ship is much more than a flotilla of financials and numbers. Naftali Holt showed me around the Celebrity Beyond, Royal Caribbean's newest ship, rolling out not the red carpet, instead the magic carpet, an example of investment that's yielding returns in several different ways.
Originally, actually, we designed it because we wanted to have a really nice platform for tendering, because sometimes we can't home port
so
destinations.
Functional.
Exactly, value fractional. And then we looked at it and said, why don't we just make it a really cool feature spot where people can enjoy it beyond the functional space, and we created this bar. It went up and down.
Now, what does it take to
How
do?
about the Instagram? Can you speak about that?
I can imagine.
Instagram moment with the sunset, having a drink with your friends or family. I mean, that's amazing.
So what does it take to do something like this? And I'm thinking cost, engineering, time.
Yeah, a lot of effort from a lot of people. So it starts from just the design and the conceptual aspect of it. Then we need to figure out a lot of technical factors, the weight, the wind, and so lots and lots of hours of really hard work. And every time we up the game, we see that customer willing to spend more.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West, only on Bloomberg Television. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
You have this US exceptionalism compared with the rest of the world.
The entire time the Fed has technically been restrictive, the US economy has grown above trend.
As long as that growth momentum stays all right, markets will be okay with it. And that, I think, is really U.S. exceptionalism.
There are still big macro risks in the marketplace.
I think it's sort of nice to say we're not really so worried about what's going to happen down the road, but the market is.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Before we get into the gloom of financial markets, can we just sit on the feeling of the sun on your skin yesterday in New York City?
This is as far as you can go for optimism?
Little glimpse of summer.
Okay.
Just there after a long winter.
And then now you're going to talk about just gloom, heavy gloom. Welcome to winter.
I'm about to.
So you're trying to
just
uplift
want to
it.
soften things up just a little
great.
bit. You know, a little bit delicate. We've been waiting for that. Smiles on people's faces in New York with the sun.
And now. And now.
I know. And now. From New York City. Biggest two-day loss on the S&P 500 going back to the bank damage of last spring. In the bond market, massive moves. Let's go through the scores. 2-year, 10-year. The 2-year, very close to 5%, 494. The 10-year, 465. We're talking about new highs for 2024. And the move so far in April, I think we have to start there again. We're talking about something like 12 sessions, something like that for the month of April so far. A move of more than 30 basis points. A move of more than 30 basis points so far in April. On a 2-year, a move of more than 40 on a 10-year.
And it's the pace that has a lot of people nervous. And the reason why, John, you mentioned it earlier, the fact that we're seeing note after note from Wall Street saying that these rates are going to bite into equity valuations, which you're seeing. But the curious thing is, people still want to buy and are overweight equities, which raises a question, where's the leadership going to come from? Not coming from small caps. It's not going to come from big tech because that's been taken on the chin. And what's going to be potentially the driver of growth?
I'll tell you where the leadership's coming from. It's coming from the US dollar and the FX market. That's all I can pick out, okay? I think we're facing the prospect of a 6th day of dollar strength. The dollar is having its longest winning streak going back to September of last year. If you push it through G10 right now, you can identify problem after problem, and I think we have to start with the BOJ. 154 on dollar yen. Remember when they were ready to defend 152? Then 153 happened last week, 154, and we're staring down the barrel at 155 this morning.
And we're staring down the barrel at 160. If you talk to JP Morgan or Bank of America, and people are saying that's sort of the new intervention point. This raises a question, are they going to be forced to raise rates in order to defend their currency? They have to take a more material stance. This goes to a broader question of how much is the disruption in the currency market, the disruption in oil market potentially going to call the hands of central banks that are kind of trying to walk on a string right now in terms of where their economies really are.
So let's go from the BOJ to the ECB. So President Lagarde last week says that we're not Federal Reserve dependent. Okay, let's run with that. Then we hear from the Bank of Greece governor that maybe we can continue to diverge. And we've heard from guest after guest that maybe you can, to a degree. And what's going to set the tone for that potentially is in the commodity market. What happens with crude? And what happens with crude, I've got absolutely no idea. We started the session yesterday, the trading week, by discussing a potential response from Israel. Are we going to get one? What does it look like? I think we can answer the first question. Are we going to get one? Israel says there will be a response. What's it going to look like? I've got no idea.
This is the question everyone's asking. And we heard from one of our guests, Janet Lowe, is talking about the fact that Israel wants to retaliate without having to spark a revenge cycle. That's very delicate. Do you do something potentially with cyber? Potentially that goes a little bit less of, bombs going off and it's a little bit more delicate? Or do you go for something like a nuclear facility, which I'm struck by the fact that Iran is saying that they want to keep them all closed because of security issues?
Crude just about unchanged today. Let's start with the price action in financial markets, starting with Brent, 89.80, down about a third of 1%. WTI down by 0.4%. 85. Need to talk about some earnings. Equities just about unchanged on the S&P 500. Lisa, B of A out about 15 minutes ago. Bank of America, upside surprise on trading revenue. The stock is basically unchanged in the pre-market.
Upside surprise on trading revenue, and as Shonali was mentioning, net interest income actually coming in above expectations, different than what we saw over at JP Morgan. The statistic of the morning, though, has nothing to do with any of these headlines. It's what Shonali said, which is the FICO score, the average FICO score, I believe, on auto loans is 800. This is basically somebody who paid every bill before they even got the bill. This is somebody who has so much money that they don't even want to borrow, but they do just so that they can have an 800 FICO score. This is banking to the elite, and this is sort of the divide between the big banks and the smaller ones.
I'm pretty sure no one around this table, apart from Mohammed, can get an auto loan from Bank of America. Is that right?
Basically, don't even try. I mean, the Tesla sort of mega truck or whatever he drives around the city is going to be financed with a loan.
Mohammed can speak for himself in just a moment. Coming up this hour, Mohammed Al-Erin on the global stock market sell-off. Bloomberg Shonali Bassett breaking down Morgan Stanley results. They drop in 25 minutes' time. And PGIM CEO David Hunn on why he says bonds are back. We begin with our top story. Equities delivering the biggest two-day drop in about a year. Mohammed Al-Erin of Bloomberg Opinion writes in the following. I've been arguing for almost a year now. Here and elsewhere, the US consumer price inflation would become sticky. Wednesday's hotter than expected data release, the third in a row, is evidence that this scenario is indeed unfolding. Mohammed's with us around the table. Mohammed, good morning to you.
Good morning, John.
It's good to see you. I won't ask you if you can get an auto loan from Bank of America. I will talk to you about what you've been writing about, though, extensively, and I think the rest of the street is catching on. I think the rest of the media is catching on as well. The amount of times we've all read articles over the last few days talking about US exceptionalism, this is something you've been touching on. What are the sources of it, Mohammed, and how durable do you think they are?
I think you have two sets of sources that speak to US exceptionalism. One is the inherent attributes of the US. It is more flexible. It is benefiting from higher labor force participation. It is more entrepreneurial. And then there's a second element, which is policy. It's been running a very, very loose fiscal policy. We're running deficits of 7% when unemployment is under 4%. That is unthinkable, but it's happening. But also, importantly, the U.S. is investing in the drivers of tomorrow's growth. And it's way ahead of other countries in that. And I think if you put all that together, you get this incredible engine that drives exceptionalism.
How sustainable do you think the second element is? Policy.
So I think it is more sustainable than people realize, but there is a limit to it. Look, this can be derailed by one of two things: oil at 110 or a Fed that's too tight. Those are these two things, and if they come together, which is a possibility, the geopolitics gets worse, then you could derail U.S. growth.
You wrote about this just in terms of the pressures of what's going on with the Middle East and the potential increase in commodity prices on the heels of that. One kind of theme we've heard is that Europe will be hit much harder than the U.S. You're saying maybe so, but it doesn't mean that the U.S. is immune. Can you elaborate?
So I think the U.S. dominates in relative space. It dominates almost regardless of what the global scenario is. But in absolute space, the U.S. has dominated so far. And for the U.S. to continue to dominate, we need to avoid really high energy prices, and we need to avoid another policy mistake. So it will dominate in relative space for a very long time.
This goes to the question that ECB board members were talking about, which is that they might not be able to cut rates because of geopolitics. Do you think that this sort of 1-2 punch is looking more likely for the Federal Reserve as well, that they will keep rates higher for longer in response to higher commodity prices, even at a time of a potential shock that could curtail growth?
So, Lisa, this is a great question, because I think most people, not everybody, most people on your show have now agreed that the last mile of inflation is going to be complicated, that inflation is more sticky. Where there's massive disagreement is what the Fed should do and what the Fed will do, right? There's massive disagreement. There are those who think the Fed should hike. You had the UBS today showing 6%. There are those who think, like me, the Fed should maintain its course and cut twice this year by 25 basis points. Now, why are we all over the place? It's because we disagree on what our star is, we disagree on what the right inflation target is, and therefore we disagree on how the Fed can best meet its dual mandate. So this is where it's going to play out over the next year. In order to predict the Fed, if you think they will remain data dependent, which they are today because they got so embarrassed by what happened in 2021, then the Fed will not cut. If, however, like me, you hope that they will go from excessive data dependency to also having a macro framework in their head and looking forward, then they would cut. And that's what we're going to see play out in the next few months.
But if they are data dependent and you see inflation, we had hot retail sales yesterday, and they do start to get more concerned about inflation, is it not just they're not going to cut, like the UBS note? Do you think they could hike?
Look, if inflation gets much worse, they could hike. But I think if they do hike, we're going to have a regional banking crisis. We're going to have all sorts of damage in the marketplace. And I think that is at the back of their head. So I think the likelihood of them hiking is low. Is it zero? No, they could.
What's the difference between them hiking 25 basis points and just holding for the rest of the year? How big is 25 basis points?
The minute they hike 25 basis points, they open the way to hiking more. That's the difference. We're going to see today, Chair Powell is going to try, I think, to do exactly what he did earlier, which is maintain maximum optionality. On the one hand, I think he's going to basically say the inflation story has not fundamentally changed, and he's going to probably use the word fundamentally. On the other hand, he's going to say, well, we need more evidence to know what we're doing. And he's going to keep his options open, and that's what he's going to keep doing for a while.
Is it too early to move away from bumps in the road? 3 bumps in the road?
I would have moved away a long time ago, but they probably will maintain the bumps in the road.
You talk about all of the disagreements, and I'm still sitting here thinking about what Fed Chair Williams, New York Fed Chair Williams said when he said, we're not really thinking about the target. We're just kind of playing it by ear and taking the data. And you talked about how the biggest debate among you and your colleagues really is, where is the end point? It basically is the destination is the biggest issue. What gives you confidence in your goal of the destination that makes you think that they should just sort of adopt some kind of belief and go with it rather than just kind of live in the morass that we're living in of just complete confusion?
So confidence I don't have, hope I have.
Okay.
I mean, there's a difference between confidence and hope. They do have a dual mandate. They do understand how exceptional U.S. economic performance has been. They're proud of it. It's incredible. I mean, you opened up with how depressing it is that we've had 2 days of massive losses. If I had come here in December and said to you all, the market is going to reprice Fed cuts from 7 to under 2, and the S&P would be up 6% in April, what would you have said to me? You would have said, you're nuts. Okay, we're still up 6% on the S&P, right? We were up 10% in the first quarter. So to go back to your question, I don't have confidence, I have hope. That's what I have. I have hope that they'll understand that they need to get away from this excessive data dependence, and they need to look forward, and they need to have a view. They're being pressed hard on tell us what your view is. And at some point, they're going to have to live on that. Now, President Williams has said, think about the target. You're going to hear this term longer term come in every time to talk about the inflation target. Yes, it's our longer term inflation target.
Yeah.
Right. Or medium term inflation target. And that's the way they're going to do it. They're not going to come out with some massive statement. They're just going to start obfuscating what exactly is meant by a target.
Can you imagine if Chairman Powell came out this afternoon and said, I don't have confidence, I have hope? Can you imagine how that would go down with financial markets?
You know what? People would clap. They would say, finally, you're telling us the truth.
End of days type stuff, I don't have confidence, I have hope. Mohamed El-Erian's going to be sticking with us. Equities right now just turning positive. Hopefully. Equities right now positive 0.1%. Let's get to the Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Donald Trump's first criminal trial got off to a slow start. Proceedings stalled over disagreements about evidence and other last-minute arguments. It meant the jury selection didn't kick off until the final hours of the day.